Fighting my humanness. What is normal behavior amongst retail traders? We know that 80 to 90% of all retail traders engage in the same self-destruction behavioral pattern. We know that some 90% of traders do not make money consistently trading CFDs or spread betting or in futures markets. It is probably also fair to assume that those 80 to 90% of traders are intelligent, ambitious, self-motivated human beings who like to create their own luck and forge their own way in life. I have never met anyone who started trading because they thought it was the same as playing the lottery. Virtually every person I have ever met who was interested in trading and who wanted to learn more about trading has been a self-starter, entrepreneur, or student at an institution of further education. Therefore, it's a fallacy to say trading attracts the wrong kind of people. It attracts the right kind of people. It attracts those who have a chance of succeeding at it. I think it attracts the kind of people who are not fooled by the get-rich-quick schemes. I doubt many traders buy lottery tickets, purely on account of the odds being rubbish, and traders understanding that all too well. Nevertheless, something is wrong. Something is wrong when 90% of people fail. In the following table, I have identified a handful of behavioral patterns that I think are detrimental to traders. The most frequently observed behavior is the inability to take a loss. What is the reason for not taking a loss? I argue there is one reason we tell ourselves, and then there is another, real reason. The real reason is always the same. Hope features high on the list of reasons. As the saying goes, hope dies last. Our minds seem ill-equipped to engage in risk management. Our minds have one primary objective: to protect us against perceived or real pain. During the process of running an open position that is producing a loss, our subconscious mind is telling our conscious mind to keep the position open. It will mask this message as well as it can, in order to protect the ego, which is more fragile than the state of your trading account. If this sounds too airy-fairy, on account of the use of words like ego and subconscious, let's explore the same argument using a different language. Avoiding pain. As long as a losing position is open, there is hope that the position will turn positive. The moment you close the position, and you crystallize the loss, the pain of the loss becomes real. I accept there are many permutations to the situation of handling a losing trade. Some will argue that the very act of closing a losing trade is the point when you can stop agonizing over the open loss and open yourself up to other trade options. I personally agree with this argument. When I have a losing position and I no longer believe in it, the worst I can do to myself and my psyche is to begin to hope. I don't feel free in my thinking and in my market perspective when an open losing position is beaming at me on my open position monitor. When I close the position, I feel free again, and I am opening myself up to taking in market information from an opportunistic frame of mind. However, my primary argument is that the reason we are hoping has little to do with hope itself and everything to do with avoiding pain. How many times did I see clients sit on losing positions for ages? I saw them deposit more money every time their losing position received a margin call. A margin call is when the broker demands more money to keep your position open. They just didn't want to take the loss. To compound my confusion, how many times did I see the position come good again, and the client close the position as soon as it did? I saw it frequently. They didn't hold on to the position because they believed in the position. They held on to the position because they could not stand being wrong. The moment they were relieved of their pain of the losing position, they got out for nothing. They were so relieved to have avoided the pain of being wrong that they completely ignored the fact that the market was now actually agreeing with them. They weren't trading the financial market. They were trading their emotions, responding to how they felt. When they felt relief that the position had come good again, they now associated a tremendous amount of pain with the thought of having to relive this anxiety once more. As a result of this association, they closed the position. They felt relieved at the thought of not having to go through this anxiety again. If you are taking your profits early under the excuse that you can't go broke taking a profit, you are reacting to your mind warning you against future pain. If you are on a winning streak and you reduce your stake size, you are essentially anticipating the pain of losing some of your gains. You are now rationalizing your way to avoid the pain, even though nothing painful has actually happened. I want to reiterate the last paragraph. If you are in doubt whether you are trading from an opportunistic frame of mind or a fear-based frame of mind, then answer this simple question. When you are winning, are you increasing your trading size or decreasing your trading size? You see, the vast majority of traders will decrease their trading size when things are going well, because they are afraid their winning streak will eventually run out. The flip side to that coin is that they might even increase their trading size during a trading slump, so they can win back the lost money. As Greg DeRiba, an S&P 500 pit trader of superior quality, said in the movie Floored, 99% still don't get it. When they win, they start betting less. Bet more. Perceived pain or real pain matters not to the subconscious. It will be treated with the same response and the same emotions. When the pain is real, i.e., real pain has manifested itself in body and mind because of trading loss, there is no end to the lengths our ego will go to in its efforts to make the money back. This is the primary driver behind the argument of, when wrong, double up. During a losing streak, we tell ourselves that we are ever so close to winning again, so the natural conclusion must be to double up in order to regain what has been lost. The real, subconscious reason for doubling up on a losing trade is to attempt to get rid of the pain. Now we are not trying to avoid pain. We are dealing with existing pain, and we are trying to get back to that state of equilibrium where we were pain-free. Act without fear. You learn a lot from observing millions of trades. If you want to stand a genuine chance of making money as a trader from the financial markets, I believe with every string of DNA within me, with every fiber in my body, that you need to change the way you think about fear and pain and hope. William Blake said that, "He who desires, but acts not, breeds pestilence." I have worked tirelessly towards being able to act without fear and hesitation. The true measure of your growth as a human being is not what you know, but rather what you do with the things you know. What do I mean by that? Have you ever seen a chart pattern, and your first impulse was to buy or sell short, but then, without warning, the very next thought was one of fear? It was a thought you had no control over. It just exploded into the forefront of your mind. I have experienced that at times in my career. When it happens, I know I need to reset somehow. Maybe I need to meditate. Maybe I need to sleep. Maybe I need to eat or go for a walk. I know that something is blocking me, and I need to resolve it. My free creative mind instructed me to do something, but my fear instinct immediately cautioned me not to follow through, because I might lose. It doesn't really matter whether you were right not to trade, or whether the position would have lost you money or made you money. Those are afterthoughts, rationalizations or justifications. We can file those under anecdotal evidence, or evidence that has no merit. We all have an uncle who smoked until he was 90 with no negative effects, anecdotal evidence, but that does not justify the argument for smoking. If my free mind argues for a position, and my fear mind argues about the consequences of failing on that trade, then I am essentially arguing with myself. The posh term for this phenomenon is cognitive dissonance. My trades need to flow from a point of freedom of expression. Trades conducted from a perspective of fear or greed will not lead to good decision-making. My advice: stop trading and start contemplating. What is going on? When I experience cognitive dissonance, it is for one or both of the following reasons. 1. I have trading fatigue, or physical fatigue. Ever heard the saying, "Fatigue makes cowards of us all"? 2. I haven't done my preparation well enough. How does she dance? Have you ever seen a market that was in free fall, and you were reluctant to sell short because you were afraid you might lose? My basic aim with this book is not to rid you of these fears. Fear will always be part of our lives. My aim is to make you understand why you feel that fear and how to process it, so you can take the trade. I accept that I am a human ruled by emotions. I understand that I can't escape emotions, and nor should I try to escape them. Rather, I want to help you understand your fear, why it is there, and how to become friends with it. Earlier in the book, I wrote about Philippe Petit, the man who walked across a wire suspended between the Twin Towers. He is afraid of spiders. Yes, it sounds silly, doesn't it? His approach to dealing with fear is worth repeating. He would do everything in his power to understand the nature of his fear of spiders. He would study spiders. He would learn everything there was to know about spiders. Through his study, he would come to appreciate the nature of his fear. How does that translate into the world of trading? Let's take a practical example. I am trading the FTSE 100 index. My stake size is around £300 a point for a starter position. Now I have to find the best entry points and the best exit points. But what do I do if I am afraid? What do I do if I am scared to place my trades because I am not sure what the market is capable of doing? The greater understanding you have of your opponent, the better you are able to understand what she is doing. I use the word opponent here, but really, the market, she is my friend. I want to dance with her. But I am afraid of making a fool of myself. So, I study her moves. I haven't seen other traders do what I do, so I argue this is a novel way of analyzing the markets. Whether it is a new approach or not doesn't matter. What matters is that I get a sense of what my dancing partner is capable of doing. What can I expect from her price behavior? Is it erratic? Is it smooth? Observe the chart in Figure 9. We are all chart experts after the fact. However, studying past pricing behavior gives me a strong indication of what I can expect for the trading day. You may see a market that initially rallies, makes a double top, and then declines. Let me show you the chart in Figure 9 from another vantage point. See Figure 10. As part of my quest to trade without fear, I break down the chart into its smallest components. I see the first wave up is 24 points. I see the retracement is 9 points down. I see an attempt to make new highs, but it only rallies 6 points. I see a deeper retracement of 12 points. I see an 8-point rally, a 3-point retracement, and another 11-point rally. The retracements lower are between 9 and 12 points, with the exception of one move of 17 points. You may argue that this is great, said with sarcasm, if you had known about it before the trading session started. Well, you did. Let me show you the day before, in Figure 11. The retracements lower are between 7 and 12 points, with the exception of one move that was 14 points. My approach to a non-fearful trading style is a combination of emotional discipline, mental warm-up, and knowledge of what the market can do. While these two trading days are different in outcome, their behavior is not altogether different. I would go into the trading day armed with the following knowledge. 1. Deep retracements and outright moves tend to be around 10 points. 2. Small retracements against a strong trend are around 3 to 7 points. Knowing this, combined with an understanding of basic price patterns, I can develop an entry strategy aimed at risking as little as possible. For example, on the previous chart, after the market has pushed higher for a move of +1-1, I wait to buy a retracement. I know that most retracements are around 7 to 12 points, with the last 3 of them being 8, 7 and 10. So now I am looking to buy. Say I buy at the point where the market has retraced -7 points. I may be fearful that the market will move against me. My knowledge of the immediate past suggests that the market is unlikely to move more than -12 points in a retracement. I therefore place my stop loss at an appropriate distance away, based on the past behavior. The discipline to wait for the right entry, combined with the knowledge of past price behavior, will set you apart from the majority of traders. They are unlikely to have done the same level of preparation. Through your preparation, and I admit, I speak for myself now, you are working through the issues your fear mind can throw at you. Your fear mind might say, what if I lose? If it does, the answer is that if the market moves beyond -12 points, your position is probably wrong, and your stop loss will handle your exit. When I lend a helping hand to struggling traders via my Telegram channel, the first thing I ask them is, do they write down their trades? By that, I don't mean write the particular trade entry on a piece of paper. I mean, do they plot their trade entries on a chart once the trading day is over? I have included a couple of examples from my own trading diary to serve as a visual reference guide. See Figures 12 and 13. I use these to warm up in the morning ahead of the trading day. I have selected random files from my old trading days, and I will relive those moments, both the terrible ones, to get me fired up on how not to trade today, as well as the good ones for inspiration. By observing my past behavior, I am able to reinforce my good points while being mindful of my weak points. I will observe the disastrous consequences of my hasty trading decisions and my impulses. I will observe trades where I didn't let my profits run. I will in essence torment myself by looking at my bad trades because I know this will act as a positive catalyst. Incidentally, I am not the only one who works like that. I read that Michael Jordan and Cristiano Ronaldo thrive on negative talk about them and their performance. They take that on board, and it acts as fuel to propel them to greater achievements. Unfortunately, no one writes about Tom Hogarth and his trading, so I recreate the situation by putting myself through my past bad trades. Not alone. The disastrous, impulsive pattern I saw most frequently on the trading floor fell into two categories. 1. Clients executed a long position in markets that they thought looked cheap. More often than not, they bought into established downtrends. 2. Clients executed a short position in markets that they felt had rallied by too much. To them, it looked as if the market couldn't move any higher. I don't blame you if you think I am making this up. Surely, traders can't be engaged in this kind of behavior in an enlightened era like the one we live in, where information flows so freely? To prove my point, I went to the IG Client Sentiment Report from the 26th of October 2021. IG Markets is a broker that has been around for some time. Their client base is global, and as such their sentiment report represents the trade positions of a large segment of the retail trading community. Before I show you the sentiment report for stock indices, I want to tell you that as I type this, on the day of the sentiment report, stock indices all over the world made fresh new all-time highs. The FTSE 100 index in the UK traded at levels not seen for years. In the US, the Dow index traded at levels never seen before. So, you would imagine that if my observations were inaccurate, the bias on the sentiment report would call for people being bullish the market. You would be wrong. Sadly, I was right about traders' behavior. 71.39% of all Dow index positions were short positions, on a day when the Dow made fresh new all-time highs. Things were not much better for the DAX index or the FTSE index. This is why the 90% lose. We don't see the market for what it is. We see it as we are. A chart is only as illuminating as our ability to keep out preconceived ideas of the direction of the market. We are not losing money over time because we don't know enough about technical analysis or the markets as a whole. We lose money because we refuse to accept what is right in front of us. My basic premise is that people, 1. Think the wrong way before they get into a trade, and 2. Think the wrong way when they are in a trade. It reminds me of the late Mark Douglas, a phenomenal light in the trading industry and an inspiration to thousands of people, when he said that good traders think differently from everyone else, at the start of his book Trading in the Zone. I have coined my own phrase. I argue that people are fearful when they should be hopeful, and they are hopeful when they should be fearful. I would like to illustrate that by use of an example. Imagine you have bought German DAX index at 15,510 and the market is now trading up at 15,525. Instead of thinking that the market may be on a tear and may go on to offer you many more points, you begin to fear that the points you have already earned will be taken away from you. Hence my saying, you should be hopeful in a situation like this, but instead you are fearful. You are afraid that the points will be taken away from you. You are not thinking about how many points this position may end up making you. Your focus is on fear rather than opportunity. The opposite holds true when you are in a losing position. You are now hoping that the market will turn around. Your sole objective is to get rid of your pain, and instead of being afraid that you're going to lose even more, you now hope that you can reach a position in which you will lose less. Every tick in your favor is celebrated. Every tick against you is ignored. If you want to trade well, you need to turn this on its head. You need to teach your brain to be hopeful about profits when it is wrongly fearful about losing the profits. You need to teach your brain to be fearful about losses when it is mistakenly hopeful about the position turning positive. It starts with being mindful of this behavior. Perhaps a conversation with a student of mine can further clarify what I am talking about. Conversation with a student. In the following conversation, my student and I are discussing a long position I have been running in sterling dollar. Student: It feels like gambling. Tom: Please explain. Student: Well, I have 40 pips in profit, but you will not let me take the profit. Tom: I won't stop you from taking the profit, but if you ask for my opinion, you should let the position run. You might want to consider the following scenarios, and then ask yourself how you would feel in each case. 1. Run position and you get stopped out for nothing. 2. Run position and it explodes higher. 3. Close position and it explodes higher. 4. Close position and it reverses. Student: I think it is best to close the position and secure the profits, rather than risk that the market will take the profits away from me. Tom: how would you then feel if the market exploded higher, in your favor? Student: I would be disappointed, but I could always jump back in again. Tom: if you jumped back in, you would have to pay commission again or at least the spread, and you would have missed the explosive move. The only way you would profit from the explosive move is if you were already in the move. Student: yes, but at least I would be playing for momentum to continue. Tom: that is true, but you are already in a position where the momentum is on your side. Student: I guess I just don't want to see my profits disappear. And there you have it, in a nutshell. People are hopeful when they are losing money. They are fearful when they are making money. I believe this is how the 90% think. It is the reason why, in a study of 25,000 traders, they won more often than they lost, but they lost 66% more on their average loss than they gained on their average win. When the trader is confronted with a loss, they hope it will turn around. The operative word here is hope. When they are confronted with a profitable position, they are afraid the profit will disappear. The operative word in this scenario is fear. My student naively thought he could jump back in again, but he would undoubtedly have had to do so at a worse price than the exit price of his profitable position. So, the trader holds onto the position until a point at which the pain finally becomes too much, then closes the position. Unfortunately, this threshold tends to be further down the road than the threshold of hope. The not-so-normal behavior. What is not-so-normal behavior? Well, firstly, I am all too aware of the shortcomings most people display when they are trading. Running a loss, cutting short the profitable positions, overtrading, trading for excitement and entertainment. But this is already known to most, if not all, people, so the not-so-normal behavior goes somewhat beyond that. It is very rare that we ask ourselves why we do what we do. Why do I trade when I do? Why do I take profits when I do? I think it's time to bring in the words of a relatively unknown trader, but one who was hugely respected by his peers. He was a pit trader at the Chicago Board of Trade, CBOT, and his name was Charlie DiFrancesca, also known as Charlie D. My hero. Charlie DiFrancesca arrived at the floor of the CBOT with a dream and a small account. He had a background in competitive college football, American style, but otherwise there was nothing about this guy that would indicate he would go on to become the biggest trader in the U.S. Treasury bond pit in Chicago. He had a rough start. He barely traded in the first 6 months on the floor. He just stood there and observed. Then one afternoon something clicked, and he traded up a storm for 2 hours, making himself $5,000. From then onwards there was no stopping Charlie D. He became a legend in the trading pit until his untimely death. In William D. Falloon's biography of Charlie D., the great trader says, "The time you know you've become a good trader is that first day you were able to win by holding and adding to a winning position." There are many people here, in the trading pit, that have traded for a long time, and who have never added to a winner. Adding to winning trades is an absolute key trait of the successful trader. It reinforces correct behavior. It serves as an antidote to the temptation of wanting to take profit. When I am in a profitable position, I have trained my mind to ask, how can I make my position bigger, rather than dwelling on the idea of taking profits. Charlie D. goes on to talk about his own mentor, Everett Klipp, who taught him about correct trading. Unfortunately, it's only human nature to want to cut your winning trades. Say I am long at 6, and the market goes 7 bids, our mind instantly thinks get me out with a profit. That's human nature. It is also human nature to ride the losses. I am stuck. I won't close. I will wait. Adding epiphany. In 2007, I met a person who was going to radically change my way of trading. It all came about by chance. I had come back from a lunch break and a colleague of mine returned from a meeting with an educational company. This educational company taught technical analysis and they were pitching their products to my colleague, who happened to be the head of marketing. What you need to know about my colleague is that he was the most obnoxious East End London guy you could possibly imagine. He was brash, obnoxious, I know, I said that twice, and arrogant, and no one could tell him anything he didn't already know. Yet somehow this educational company had gotten his attention. He spoke glowingly about a gentleman called Dr. David Paul, who had taken him through some basic technical analysis. He showed me the technical analysis, and it was basic. Yet there was something about the course material, which I had been given a copy of, that told me that I needed to engage in a conversation with this gentleman. It turned out that Dr. David Paul had a 2-day trading course coming up in Johannesburg. So a few days later I booked myself onto a flight. It was one of the only times I have ever participated in formal training on the topic of technical analysis. I have mentioned him before, but I'll describe him a little more now. There is something incredibly humble about Dr. David Paul, despite everything he has accomplished. He has a PhD in mechanical engineering. He used his immense abilities to invent a drill for miners in South Africa. This was no ordinary drill. It was the kind that sucks gas out of the ground as it drills, and thus saves lives by more or less eradicating the occurrence of explosions. David Paul spent much of his time investing and trading. He made himself a wealthy man. On the second day of the course, David said something that would change my perspective on trading. He said something along the lines of this: when you are in a winning position, instead of thinking where to get out, why don't you think about where to get in more? He basically told me to turn everything upside down. Most traders with a profit will begin to contemplate where to take half the profit. Next, they will begin to contemplate where to take the next half of the profit. David argued that this was what the 90% would do. He didn't use those exact words, but he did argue that if you want to make money trading, you need to do that which the majority finds difficult to do. The first time you try it, you may fall flat on your face. That is to be expected, but the next time it might be a little easier, and the next time a little easier again. Do what is hard. David was essentially arguing that when you are in a winning position, you should put pressure on your position. The argument for doing so was something he himself had observed when the market really began to trend. I have tried to put a different spin on his words. When you want what you want more than you fear what you want, you will have it. You want profits in your trading. You probably have a good instinct about trading. You probably also realize by now that it is your thinking that causes your problems, rather than your knowledge about the financial markets. If the 90% of traders are engaged with taking half profits and letting the other half run, maybe the right thing to do is to double up on your position, or perhaps conservatively add a little to the position, when everyone else is taking half the profits. At least this is what I read between the lines, as I sat in that hotel conference room in Johannesburg. When the workshop was over, I walked across the street and locked myself into my hotel room. I sat down and waited. The Dow index was trending. I waited for a retracement. Then I waited for a 5-minute bar to close above the high of the prior 5-minute bar. Then I bought. 10 minutes later I added to my first position. 20 minutes later I closed at a double top. It was the most satisfying trading moment in my life. A whole new world had opened up to me. Depending on your experience level, you may or may not be able to answer this question. Why is it easier to add to a losing position than a winning position? I have wondered about that myself many times. You decide that you want to buy the DAX at 12,325. The market then moves down to 12,315 and you are tempted to add to the position. Why? Why is it easier to add to a losing position than to a winning position? Well, for starters, you would have loved to have bought at 12,315 rather than 12,325 because you would have gotten a better entry price. Therefore, buying again at 12,315 makes sense from an economics point of view. That is plain simple logic. There is a chance that you have a stop loss in mind, and there is a chance that you have a target in mind. Now you have an opportunity to have the same stop loss as before, but you have 10 points less risk, and you have more profit potential. You have also created a better average price, so the market has to move fewer points in your favor before you are at break even. Simple and logical, something our minds love. However, you will now also have added to your position exposure, and the market has told you that you are wrong, at least right now. It was easy to do the wrong thing because we attach a value to the market. When the market gives an opportunity to increase the value of our trade, it will seem compelling to us. So why is it difficult to add to a winning trade? If I bought at 12,325 and the market is moving in my favor, I am relieved. Now other emotions will enter the consciousness. There will be greed. You want to make more. There will be fear. You want to protect what you have made. When the market reaches 12,345, you will be thinking that if you buy more now, you have increased your average price to 12,335. It means that the market will only have to move 10 points against you before your position will be at break-even, rather than in profit. The key point here is, what is your mind dwelling on? When we add to a losing position, we decide to dwell on the potential for bigger profits. We decide not to dwell on the fact that the market is telling us we are wrong. We decide not to dwell on the fact we have just doubled our risk. When we add to a winning position, we decide to dwell on the fact that the market may take our profits away, because we have now decreased our average price. We decide not to dwell on the fact that the market is corroborating with us. Put simply, the market disagrees with us, but we have faith that the market is wrong, and we add to a losing position. Or the market agrees with us by showing a profit, but we doubt the market is right, so we don't add to our winning position. It doesn't quite make sense, does it? And yet, this is what the majority of traders are doing all the time. Adding to a winning position can be uncomfortable to begin with. No one is saying you have to double up on your trading size the first time you add to a winning position. You could add just a little bit. Adding strategies. There are two ways you can add to your winning trades. You can use a same size principle, by which you keep adding the same size. Say you buy 10 lots to begin with, and then you add 10 more lots at a higher price, and so on. That is a risky way of trading. Instead, you could use a second principle, by which your first position is the biggest position, and subsequent positions are smaller. So your first position might be 10 lots, but the subsequent positions might be 5 lots. When I trade, I pretty much always use the same size principle, but I urge you to use the second principle until you are comfortable with adding to winning trades. Building new pathways. The purpose of adding to winning trades is at its heart an attempt to fight your normal human behavior. In the beginning, it is not about adding to your profitability. That will come later. The purpose is to stop you from taking half profits. By adding to the winning trade, by thinking, how can I make more when I am right? Rather than thinking, where should I take profit? You are building a new way of thinking about trading. Do you remember what Mark Douglas said in the opening lines of Trading in the Zone? In trading, consistent winners think differently from everyone else. When you start to think, where can I add to my winning trades? You are beginning to think differently. From then onwards, it becomes a matter of habit. You have built a new neurological pathway in your mind, or at least taken meaningful steps in the right direction. Controlling risk. How do you control risk when you add to winning trades? This is a question I am often asked. The answer is the same whether you are adding to a winning or a losing trade. You place a stop loss. Some who receive this answer will say, but if I get stopped out on an add-on on a profitable trade, then I will have lost profits from the original trade as well. Yes, that is true. But isn't it better to get stopped out of a trade where you have some profits to cushion your loss, rather than having added to a losing trade, where you are now feeling the full force of the loss? At least when you add to a winning trade, the market is currently agreeing with you. I have just bought the Dow at 26,629. My stop loss is 26,590. The Dow has already rallied from a base of 26,569, so I might be a little late to the party, but that doesn't bother me. Many a good trade has been missed by those arriving too late to the party. As long as I have a stop loss in place, I am fine to join a momentum move, even one that has been moving for a while. The Dow prints 26,649, and I buy once more. I am adding to my winning position. Now my stop loss on the first position I bought has been moved to reflect the fact that I have taken on more risk. My first stop loss is now at 26,629. The stop loss on my second position is also 26,629. At this point, two things can happen. Ideally, the market will carry on moving higher, and every point move is now making me twice as much as if I had only one position. The less appealing alternative is that the market moves against me, and I will get stopped out of the first position at break-even, and I will lose 20 points on the second position. There is no magic to it. It is a philosophy, and it is born out of a desire to not be normal. The normal thing to do is to close half your position and let the other half run. Why would you do that? Why would you have the market agree with you, but you only ride it with half a stake? That is what the 90% are doing, and I don't want to do what the 90% are doing, no matter how logical it may seem. They are wrong over time, and I want to be right over time. It is such a crucial point I am attempting to get across to you, right here and right now. I don't know what is going to happen over the course of one trade. Anything can happen. However, I do know what will happen, statistically speaking, over the course of 100 trades. Over the course of one trade, you may win, or you may lose. Over the course of one coin flip, you may get a head or you may get a tail, and you may get 5 tails in a row, but you will still end up, statistically speaking, with a 50-50 outcome when you throw the coin 100 times. The same applies to trades. You may be on a hot run and have nothing but winning trades on your screen, but over time it will even itself out. Therefore, it is vitally important you don't think too much about the outcome of one trade, but rather the outcome of 100 trades. The outcome of one trade is random. The outcome of 100 trades is predictable. It is for this reason that our behavior needs to be the same for every trade we execute, whether we like it or not. By applying the same correct behavior to every trade, we are virtually guaranteed to be profitable. What is the correct behavior? Well, why don't we observe what everyone else is doing, and then do the opposite of what they are doing? The basic premise is that the majority of people who trade end up losing money. That is our starting point. Now we observe what those people do. I have been doing that for 10 years. Here is what I observed. 1. They don't add to winners. They don't add to winning trades. So, to be profitable, add to winning trades, whether you add a little or you double up. Start slowly, add a little. 2. They don't use a stop loss. They don't like to use a stop loss, because that would crystallize the pain of the loss. As long as the position is open, there is hope. So, to be profitable over time, use a stop loss. Use a stop loss on your first position and on subsequent positions. 3. They add to losing trades. We all love a bargain at the local supermarket, don't we? And by all means, continue to shop for bargains at the local supermarket, but do not do it in the financial markets by buying more, just because you can buy it at a cheaper price than the first time you bought it. 4. They take half profits. This one is going to be tough to argue, so bear with me. I know so many traders, even people who have traded for decades longer than I have, who advocate taking half profits. Their thinking goes along this pathway. I will risk 20 points. I will take half profits at 20 points and move stop loss on the other half to break even. I will take the other half profit at 40 points. It sounds so compelling. You close half the position, so if the market turns around, at least you will have made 20 points on half the position. I can understand the thinking behind it. The problem I have with this strategy is that it never gives you the home run trades that you need to sustain yourself in this business. You will never be on board the big moves because you have always limited yourself. Risk to reward. Did I just say that I don't believe in the whole risk to reward argument? Yes, that is correct. I do not. I believe in defining my risk. I don't believe in defining my reward. When I am about to execute a trade, there is only one variable I have meaningful control over. How much money, points, pips will I risk on this trade? Anything else is pure guesswork. How much I will make will depend on the market. It will not depend on me unless I put a limit on my profits. A very wise old trader once told me that losers spend their time thinking how much they will make, while winners spend their time thinking about how much they will lose. The only variable I am in control of, as a point-and-click trader, as opposed to one who uses an algorithm, is how much I can lose on a trade. Observing hundreds of millions of trades over a decade, executed by an army of well-meaning traders doing their best to make a profit, I have come to the conclusion that setting a limit on your profits is not the way forward. If I buy the FTSE 100 index at 7,240 with a stop loss at 7,235 and a take profit target at 7,250, I am sure I will be happy if the FTSE goes to 7,250 and reverses back down again. However, how will I feel if the FTSE moves to 7,260 or 7,270 or higher? Of course, there are exceptions to this rule. I may genuinely want to get out at 7,250 because I feel there is overhead resistance at this area. It may even be an area where I would want to sell short the market. I may also put in a take profit order at 7,250 because I may not be able to follow the market as closely on this particular trade. But generally, I do not work with targets because a target will limit my profit, particularly on days where the market is in a runaway mode. With this in mind, I would like to show you an example of a decision I made and how it ended up costing me dearly. How not to do it. The DAX gapped up, as shown in Figure 14. I know from statistics that 48% of all gaps get filled on the same day they occur. Considering that 90% of daily highs and lows occur in the first hour and a half of the trading day, I felt reasonably good about shorting the DAX on the low bar, indicated by the arrow. The stop loss was close to the high of the day. The risk was 35 DAX points. As shown in Figure 15, instead of continuing lower, the DAX index consolidates and moves higher, and it eventually takes out my stop loss. I am now at minus 35 points. The previous pattern does suggest higher prices to come. Yes, it looks like a double top sell, but on a gap-up day, the odds are higher of continuation than of a reversal. Remember the saying, in bull markets, resistance is often broken, and in bear markets support rarely holds. Well, you can replace bull markets with bull trends and bear markets with bear trends. In Figure 16, I execute a long position on the close of the bar, as it closes above my stop loss. It is in reality a stop and reverse situation. I am stopped out of my short position, and as a result of it, I am going long. The market moves into a consolidation and eventually breaks higher. I add to my long position, as shown in Figure 17. So far everything looks okay. Then I make a mistake. I am at this point able to close the position with a profit that exceeds the loss I made earlier. Do you see what I am doing wrong now? I am not trading the chart. I am trading my account. I am trading my state of mind. I am trying to get rid of the pain from my previous trade. You can see this in Figure 18. Much to my disappointment, I admit I closed my long position for no other reason than being able to offset the prior loss. I talked myself out of the position rather than just moving my stop loss higher. It is not until my review of my trading day that I really come to realize what I have done. For now, the market is not entirely in disagreement with me. For the next 2 hours, the market trades sideways. The longer a market moves from a trending market into a sideways market, the less the prior trend matters. At least that is what I tell myself. Then, as the US markets opens, the DAX index moves higher, and I am not on board. You may not yet see the subtle point I am making here, so let me point it out to you. I do not belong to the brigade of traders who believe that you can't go broke taking a profit. I do think you can go broke taking a profit if it means you never have really big profit days because you are unable to let profits run. Simple as that. Figure 19 shows what happened after my exit. While I don't insist on perfect trading, I review my trades religiously to pick up on errors creeping into the inner workings of my trading mind. Am I maintaining my discipline? Am I adding to winners? Am I impulsive? You may look at the chart and think I did okay. I look at the chart and I wonder why I got out. The pain of having missed out on the rally towards the end of the day was greater than the pleasure from making back what I had lost earlier in the day. Pressing winners. Adding to winners is habitual for me. I have new and experienced traders following me on YouTube and Telegram exclaiming they want to know how I do it. One simple way of doing it is to look over the prior trading days and come up with a number of points at which you will want to add to your position. For example, you may look at euro-dollar and conclude you want to add to your position at every 10 pip interval. I went about my approach in a different manner. I think it is best illustrated through the use of a theoretical explanation. I want to trade the FTSE 100 index, and I am looking for an approach to adding to my winning trades. How do I go about doing that? Step 1. I need to establish what the historical volatility is in this index. I use a measure called average true range, ATR. When using it, I carefully differentiate between periods in which I don't want to trade the product and those in which I do want to trade the product. For example, the volatility of the FTSE index on a 5-minute chart during the night could be around 4 points, while the volatility on a 5-minute chart at the open at 8 a.m. Greenwich Mean Time is around 14 points. That is a significant difference. Say for the sake of argument that I have established that the volatility is equal to 10 pips, 10 points where I day trade the FTSE index on the time frame I prefer to trade. We call that value n equals 10. My stop loss is 2 times n. Step 2. Establish how much money you want to risk on a trade. This is a percentage function of your account value. Say you have £10,000 in your trading account, and you decide you want to risk 2% of the account. Hence, 2% of £10,000 equals £200. Step 3. Now I establish my trading size unit, which is essentially how big my trading size is. If n equals 10, risk equals 2n, monetary risk equals £200, then my trading size unit will be £200 per 20 equals £10. Step 4. I can then argue that I want to add to my position at every 1/2 n. I think this is where your own research should come into play. However, for the sake of the argument, I will take you through an example, based on the numbers above. Example. I buy the FTSE index at 7,500. My stop is 20 points. My risk is £10 per point. My add-on is at every 1/2 n. This means I add at every 5-point increment. The FTSE index now trades at 7,505. I buy one more unit, meaning I am now buying £10 a point at 7,505. I now have 2 open positions, long 7,500 with stop loss at 7,480. Long at 7,505 with stop loss at 7,485. As you can quickly gather, this will cause a bigger loss than anticipated if I do not move my stop loss up on the first position. Before I enter the second position, I have already planned to move my stop loss up by 1/2 n. I will move the stop loss up on the first position by 5 points. This means that the stop losses on the first and second positions are identical. My total risk is now 35 points. As I hope you can see, this way of trading can quickly materialize a larger loss than perhaps you had wanted it to. It is for this reason I urge you to consider variations of this method, such as adding with smaller stake size on the second, third, and fourth positions. You may ask, why add at all? Because by adding, I am actively combating the brain's proclivity to scaling down risk. Our brains want to take profit. I am doing the opposite. I am adding to my position. Real-life example. The following chart shows the Dow Jones Index on a trend day. I define a trend day as a day when the market opens at the high or the low of the day, and closes at the low or the high of the day. The problem with trend days is that you won't know it was a trend day until the day is over. So, you have to make an assumption, based around what you see on the chart, about whether you think it is a trend day. I have researched the price action behavior of the Dow Jones Index over 18 years. I have identified a handful of first-hour patterns, which I believe are precursors for trend days. One of those patterns is a gap down after a gap up day, where the gap down is not filled within the first hour. Figure 20 shows a positive Thursday. The trade I want to show you took place on the Friday. Friday is notorious for producing lasting trends, often leading to trend days, especially on Fridays at the beginning or end of the month. I have also included a screenshot of my trading monitor. The top line shows my overall exposure. It states I am short 3,000 inches Wall Street. My average entry is 25,419.6. The current price is 25,135.9. The 3,000 means I am short 3,000 Danish kroner per point, which equates to about $500 per point movement in the Dow. So, for every point the Dow index drops, I make 3,000 kroner, and vice versa. For every point it rallies, I lose 3,000 kroner. At the time of the screenshot, I am in profit by 851,000 kroner. Below my total exposure, you see each of the entries, which add up to 3,000. If you look at the previous chart, you will see the numbers 1, 2, and 3. Those are points where I am adding to my position. At point 1 on the chart, I start selling short. I scale into my short position over 5 entries. Those are the first 5 entries you see below my total exposure. At point 2, I add more short positions. I do so because the market is weak, and I am certain a trend day is developing. I add about 25% more to my short position at point 2. At point 3, I add about 10% more to my short position. As the market moves lower, I add to my positions, as I have been trained to do. I move my stop loss down as well. What you are unable to see on the chart is that initially the market moved against me. What I am doing here is critical to your understanding of fear. I have been underwater on my position, and now I am finally making money. My brain has had to endure pain during the loss period, and I am now being sent signals from my mind to relieve my brain of the pain it felt during the losing period, 15 minutes earlier. I counteract this pain by actively doing the very thing that causes me pain. I am embracing the discomfort by compounding it. This is required if I am to actively engage in behavior that is the opposite of the 90% S. You will notice that my add-on is not a big position. Yet, it serves to reinforce the right kind of behavior. The Dow falls strongly. I am in the safe zone now. My core position cannot be threatened. My stops are placed at break-even. However, I am still prepared to let this trade turn into an insignificant trade, small profit trade, in the hope that it will turn into a significant trade. You must find your own level of risk temperance. Once I was asked, if you keep adding to your trades, when do you take profits? That is a great question. I use the charts to take profits. If I double bottom on a chart, and I am short, then I might be tempted to take profit. Alternatively, and this is a really good trick, I will place my stop loss where I would want to get into the market, but in the other direction. For example, in this case, if I am short the Dow Jones Index, I might place my stop loss at the price level where I would turn into a buyer of the index. Although I am 100 points in profit, I am by no means relaxing. I am adding to my position again and again, in smaller increments, in order to reinforce the right behavior. The trade had the potential to turn into a spectacular trade. It didn't. The Dow bounced strongly, before falling again, and although I made a profit, it was not the amount you see on the screenshot. That is very important for me to get across to you, because I think it is important that you establish some criteria for how much of your paper profits you are prepared to give away in order to capture the really big days. There are days when I come to work, and I just want to capture 20 to 30 points, and then be done. Not every day has hundreds of points available in it. Then there are days when the market starts out very strongly or very weakly, and you think to yourself, this could be a really big day. I have a philosophy to trading that means I am prepared to sacrifice profits in order to discover how big the profit can get. If you don't have that philosophy, you will never discover how big the profit can get. If you always think of potential targets, using technical analysis, you are most likely just talking your way out of a good trade. You might be using technical measures to time your exit, but I don't subscribe to this method. There is a reason for that. When the market is trending, and I am on board the trend with a position, I hope that the market will close that night at its strongest or weakest for the day. It happens on at least 20% of all trading days in stock indices. Yes, I have had plenty of disappointments, but I have had sufficient stellar days to make it part of my philosophy. DAX Index, trading example. Let me show you another example of a trade where I added to my positions. However, this time I will show you what I saw at the time I am not on board the first pushdown. I look at the rebound for an opportunity to short the DAX index. On the next image you can see my initial position entries highlighted in box 1. DAX finally caves in and resumes its downtrend, as shown in figure 22, page 157. You can see my subsequent short entries in box 2. There are a couple of things I would like you to see here. 1. I am not afraid to sell short something that has already fallen in price. This is consistent with what the majority of people do not want to do. 2. I scale into the position in this example, and I add aggressively to my short position once my position is in profit. I urge you to contemplate how you can introduce the element of adding to winners into your trading. I am not interested in rewriting your trading plan. I am not interested in turning you into a copy of me. I am interested in trying to make you understand the value of pain in trading as a barometer for adding to positions. If it is uncomfortable, then it is probably the right thing to do. I will repeat something I mentioned earlier. I think you should give serious contemplation to the question of why people in general find it easier to add to a losing trade than a winning trade. I don't ever want to be accused of glorifying trading. It is a risky proposition. 20 years ago, most brokers in Europe didn't have what we today know as negative balance protection. Today, it is a legal requirement. It means that you can't lose more money than is available on your trading account. You can still lose a lot more than you anticipate, especially if you add to positions, like I do. As you become better at trading, you will want to trade bigger and bigger size, and the market on a big position doesn't have to change direction by a lot before you give away a big portion of your open profits. If you want proof of that, here it is. This was a perfectly good-looking DAX position which turned from being very profitable to showing a significant loss. It starts well with a short position at 11,288. I then add to the position as the DAX index falls. Then the market reverses, and I add a little more at the old top. At the point of the screenshot, I am short 4,500 kroner per point, and I am losing 25 points. I close the position shortly after for a loss. Uncomfortable. There are no shortcuts in the trading industry, any more than there are shortcuts in, say, professional sports. I expect to get uncomfortable during the trading. At times, it feels like the minutes last for hours. My impatience to do something is raging within me. I am battling my own emotions more than I am battling the markets. Finally, when I am in a position, my mind has something to occupy itself with. Be careful what you ask for. Maybe the position is showing a loss, so now I am battling my subconscious mind, which wants the position to run a little longer. My conscious mind has a stop loss, but my subconscious mind wants me to remove it. It doesn't want to lose. It could be the position is going well. Now my subconscious wants me to take my profits. It loves the gratification of a good profit. So, I am battling it whether I am winning or losing on my trades. The key to victory starts with being mindful of the existence of two brains. The ability to anticipate your enemy's next move is crucial. The subconscious brain is a rather simple beast. It just wants to avoid pain. For the subconscious brain, there are two pains in trading. There is the pain of seeing a profit. When it sees a profit, it wants you to close it because then it doesn't have to deal with the pain of seeing the profit disappear. Then there is the pain of loss. When the subconscious brain sees a loss, it wants you to hold on to the position a little longer and a little longer. Otherwise, it will have to deal with taking the loss. As long as the position is open, there is always hope. In a nutshell, what separates the 10% of winners from the 90% of losers is which brain they are listening to. It took me many years to realize this. I developed a system for my mind, a training program that enabled me to withstand the influences of the emotional subconscious brain on my trading decisions. During the round-the-clock trader event referred to previously, a guest asked me if I wasn't afraid that the market would turn back up the moment I went short. Who do you think was really asking that question? It was the part of his mind controlled by fear. Of course, the market might very well turn around. I would lie if I said that had never happened. It probably happens 5 times out of 10. So, the real question to be asked is this: what would cause you more pain? 1. You sell short and the market reverses back up. 2. You do nothing and the market reverses back up. 3. You sell short and the market continues lower. 4. You do nothing and the market continues lower. Option 1. I sell short and the darn market moves against me again. It is annoying, but the stop loss will take care of my exit. At least I can say that I followed my plan. Option 2. I do nothing and the market moves back up. I might be happy, but I have just trained my mind not to follow the plan, and I was rewarded for it. I was rewarded by not selling short, which would have lost me money, and my mind is now congratulating me for my excellent chart reading skills, but for all the wrong reasons. Option 3. I sell short, like I am supposed to, and the market follows through to the downside. Instead of clapping my small paws in joy, I am proactive, and I add to my winning trade. I am doing absolutely everything I am meant to do. Option 4. I decide not to follow the plan of shorting, and the market moves aggressively lower. I would have made all the lost money back from the first trade, but I do not. I can't speak for you, but I will tell you how I feel about it. It causes me more emotional pain to miss a move because I didn't follow through on my plan than when I followed through with my plan. What is too far? Another question that came in after the short trade was this: were you not concerned that the market had already moved too far? Do you not think you had already missed the boat? The person who asked this question is most likely the same person who would not buy the DAX because it had already rallied 1% on the day. This is the supermarket analogy all over. We seek out bargains, but we avoid buying items that have risen in price. It is a mental illusion. You can't say the DAX is too expensive just because it has rallied 1% on the day. We do not want to buy something that is already going up. We would rather wait until it comes down again to buy it, because then it is cheaper. Similarly, we do not want to sell short something that is already going down. We want to wait for it to rise again and sell it when it is higher, more expensive, because it gives us better value. In principle, I don't disagree with these statements, but here is the flaw. That is what everyone else wants to do, and the majority tend to be wrong. Correction. They don't tend to be wrong, they are wrong. Sure, they are right 60% of the time, but when they are wrong, they are really wrong. How do you know where the top or the bottom is? I have seen a lot of trading systems, but none of them had an acceptable success ratio of predicting tops or bottoms. This is why I say that you should buy strength and you should sell weakness. Buy high, sell higher, sell low, buy back lower. Will I miss the absolute turning points? Yes, I will. Top pickers and bottom pickers soon become cotton pickers. When I am distressed about profits disappearing, I remind myself of the story of a US super trader whose reputation for doing the right thing under pressure is legendary. His name is Paul Tudor Jones. He was once watching the market and, as it had been rising all morning, he had been buying steadily. He was long several hundred contracts showing a good profit. Suddenly the market jolted lower for no apparent reason. Without blinking, he sold out all his long positions, and as the market continued to fall, he started to sell short the market too. One of his colleagues who didn't know he had commenced shorting the market commented on the fall and said this was a good chance to start buying. The conversation, edited for expletives, went on as follows. "Are you mad?" said Paul. "What do you mean?" said the colleague. "You must be mad. The market has just broken 100 points in 15 minutes, and you are looking to buy it? Well, what would you do? Let's put it this way, I am certainly not looking to buy it here. Well, would you sell them short here? Of course I would. But they have come down so far. Exactly, that's the point. Right, said the colleague. Well, just how far would the market have to fall before you started to buy it? As long as it is going down, why would I buy it? Because it's so cheap, it's an absolute bargain. It's 100 points cheaper than it was 15 minutes ago. Forget cheap. Forget expensive. It's just numbers on a page. But I don't understand. If it kept going down, where would you try and buy it? If it kept going down, I'd want to be selling it, not buying it. If it kept going down, I would sell it down to zero. And if it was going up? If it kept going up, I'd buy it to infinity. I absolutely love this story. Having seen Paul Tudor Jones trade, you sense his energy, his intensity and determination, and his utter conviction in whatever he does. He doesn't just say, sell short. He shouts, sell short, stamps his feet and swings his hands. I admire his mental agility, flowing from being convinced on the long side to turning the position to the short side. Sadly, this is one trait that is hard to acquire. I know some traders with decades of trading experience who are unable to flip the switch and go from being long to being short. Finding a low. Trying to find the low in a stock can be a costly affair. We all make mistakes, but how costly is the mistake going to be? I remember very vividly watching a CNBC show called Mad Money during the financial crisis in 2008. On the show, Jim Cramer received an email from a viewer asking about the health of Bear Stearns. Now I am sure that if Mr. Cramer had an opportunity to go back in time, he would most certainly amend what he said in that broadcast. He basically shouted at the screen, saying that Bear Stearns was fine. But a few days later, Bear Stearns was gone, done and dusted, never to be seen again. You may recall my first brush with meeting clients back in 2001. I gave them the not-so-welcome advice to get the hell out of their Marconi shares. Would you believe it if I told you that history repeated itself in 2007? It is easy to be swayed by a supermarket mentality when we are trading. As I mentioned previously in the book, when we go into a supermarket, we are drawn towards the special offers. When I look at my shopping basket from this weekend, I see things that I wouldn't normally buy. Of course, I would need these things at some point or another. We all need toilet paper. We all need dishwasher tablets, and we all need hand soap. The reason why they were in my shopping basket this week was because they were on offer. Who can resist a 50% discount? But a 50% discount in a supermarket is not the same thing as a 50% discount in the financial markets. Many clients of City Index, the broker I worked at for more than 8 years, came face to face with this reality during the financial crisis from 2007 to 2009. In 2006, after having done very little for years, a stock called Northern Rock went on a tear. It rallied 50% in months. There was no real interest from City Index clients in the stock during the rally phase. However, when it began to slide back down again afterwards, the interest rose. It was as if Northern Rock had the same effect on investors that half-price toilet paper has on shoppers in a supermarket. Northern Rock became quite a lively traded stock. The more Northern Rock fell in price, the more people got interested in the stock. At one point, I received a phone call on a Saturday morning at home. At this point, Northern Rock had slipped from 1,200 pence down to around 500 pence. The person on the other end of the phone was a stranger to me. He had picked up my business card at one of the talks I had given on technical analysis. He apologized for calling me so early on a Saturday morning, but he and his friend had decided to invest in Northern Rock. They had decided to get the opinion of a professional, just to double-check whether it was a good idea. Apart from being rather annoyed at being woken up at 7 a.m. on a Saturday by a stranger, I was also annoyed with the question. At this point, Northern Rock was in free fall. I roughly said the following to the stranger. Look, I don't know what is going on with Northern Rock, but there is something horribly wrong. Although the general market is declining too, Northern Rock is declining much more. What I am afraid of is that there is something amiss that we don't know about, and it has yet to be known to the market. It feels as if someone somewhere knows something is horribly wrong, and they are selling out while they can. I told him that I had many clients who had said exactly what he was saying now, but about Marconi 5 years earlier. Fortunes were lost by clients who kept buying Marconi, even though it was falling and falling, because they engaged in bargain hunting. It had been horrible to see the losses our most valuable clients endured simply because they did not want to admit they were on the wrong side of a bad share. I said to him, from a trader's perspective, you are engaging in a very dangerous activity. If you buy Northern Rock now, it will be very difficult for you to have a meaningful stop loss. You are essentially trying to catch the falling knife. You talk as if Northern Rock is the only bank in the world worth investing in. You talk about Northern Rock as if it couldn't go bust. You talk about it as if the fact that it is 200 years old means that things couldn't get worse before they get better. You even said it yourself. Northern Rock is too big to fail. It means you are already to some extent aware of the danger here. I asked him if he remembered Barings Bank. He did. There is a second reason why I don't think it's a good idea you buy Northern Rock, I continued. Let's say you are fortunate enough to witness a turnaround in the fortunes of Northern Rock. You will have trained your mind to think that it is perfectly okay to buy into things that are falling. This works perfectly in a supermarket. Toilet paper has a practical use. Soap has a practical use, so when you are provided with an opportunity to purchase these items at a 50% discount, you should do it. However, to believe that the financial markets offer discounts akin to what you're seeing in a supermarket is ludicrous. The financial markets are not a supermarket with special offers. Eventually, Northern Rock went bust. The British government had to guarantee customers savings. That didn't stop panic scenes as people queued up to get their money out. Thinking right. As you read this anecdote, you might think it could never happen to you. Perhaps you are right. I am not going to suggest otherwise, but I would like to ask you a simple question. Imagine you have two investments. Investment A and Investment B. Each investment had equal starting value of $100,000. Investment A is doing well. It is up 50%. Investment B, on the other hand, is not performing. It is down 50%. You are now in a situation where you need $50,000. What do? 1. Close a third of investment A to raise $50,000. 2. Close investment B to raise $50,000. When I asked this question to a group of investors at a conference in Copenhagen recently, the overwhelming majority opted for option 1. They would close enough of investment A to raise the $50,000. Why do you think that is? Why do you think people close the investment that is doing well? My theory is it all boils down to how people react to taking a loss. Are they able to take a loss and move on? Or are they so averse to taking a loss because as long as the position is open, there is hope it will come good again? Of course, it is impossible to say exactly how you would react in this situation, but I don't have to rely on fictitious examples to get an answer. If you recall the chapter where I spoke about the 43 million trades executed by 25,000 traders, you will remember that those traders lost more on their losing trades than they won on their winning trades. Emotionally, a loss is clearly felt much harder than a win. Otherwise, there would be no reason for this anomaly. Human beings postpone making decisions that will cause pain. It is the reason why we let losing trades run. We want the instant gratification, but we want to delay the pain. Hope dies last. As long as the losing position is open, there is hope. The junkie and the CEO. I use an analogy to illustrate the concept I have just explained. It is akin to firing the CEO of a successful Fortune 500 company and betting your money on the junkie turning his life around. Crude? Yes. The junkie might turn his life around, but I think the odds of the CEO continuing his successful run are higher than those of the junkie turning a corner for the better. That is why I am arguing that trading is so much more than technical analysis. That is why I am arguing that we need to learn to handle losses a lot better than the general population does, because they handle them very poorly, and as a result they are generally unable to make money from speculation. Control your mind. Control your future. I am not a masochist. Nothing could be further from the truth. If I do tend to dwell on pain, it is more a reflection of pain's role in the context of trading profitably. What I'm attempting to do is a difficult endeavor. I'm trying to explain why 90% of all people fail in achieving their hopes and dreams when it comes to trading. When so many people commit the same mistakes over and over, there must be a deeper meaning that has yet to be uncovered. Naturally, I'm hoping that by now you will have a much greater understanding of what it is that is going wrong. My own motto is, control your mind, control your future. Doing so requires constant vigilance. You have to own your life. If you don't own it, you are not the boss. You have to take full responsibility for everything that you do. You must be the master of your own kingdom. You can't walk through life with your eyes half shut. You have to walk through life with your eyes fully open. You have to know what you are getting into, be prepared. You have to take possession of your life. This is a thought process you have to constantly reaffirm. Our minds tend to drift. There are so many distractions in life, so much superficial noise that doesn't bring substance but that our brains are attracted to nonetheless. The brain would rather look at Facebook and YouTube than sit in quiet contemplation. The drifter brain needs to be controlled through daily vigilance, whether it be through a mantra or meditation or whatever you decide suits you best. As a famous doctor once said when asked what exercise is best for us humans, it's the one you do. It doesn't matter whether you meditate or write a diary or do whatever other practice you choose to center yourself, so long as you do it. There needs to be a regular time in your day where you remind yourself of your purpose, of who you are. The world is full of temptations that distort a healthy self-image. The temptations take us away from who we are by telling us that who we are is not enough. But you are enough. Being a good trader really has little to do with tools and charts. It has a lot to do with fighting our humanness. If you really want to trade the markets using leverage, engaging in high-octane speculation, you have to learn to desensitize your normal emotional response mechanism to fear, greed, and other delightful human reactions. You have to fight your humanness. Disgust. Many years ago, when I was just a young man, I had a girlfriend. She was my first real girlfriend, and I was her first real boyfriend. We were young, and we were very much in love. My girlfriend was a little round bodily, which I found very attractive. She, however, did not like her body image, so she began to diet. She had dieted before, but had always failed to sustain a weight loss plan. Now she was in love, and her motivation shifted into another gear. The weight loss became quite dramatic, and it led me and her family down a path that pains me to write about. Anorexia is a serious psychiatric disorder, but, and forgive me for using a tragic story to illustrate a point about behavioral change, it is an interesting motivational phenomenon. We are hardwired to eat. We need no training to eat. Yet somehow this hardwired pattern is overridden by a social motivation, the desire not to be overweight. This force, this motivation, is so strong in patients with an eating disorder that it proves to be impervious to both medical and psychological treatment. What is the basis for this powerful motivation? It isn't chanting, and it isn't positive self-talk. As I understand it, my girlfriend was motivated by love, but more importantly by disgust. She was disgusted by anything that looked and felt fat and overweight. This force was so strong it could disrupt her hardwired pattern of eating food. As humans, we are driven forward by forces. Those forces can be born out of a desire to move away from something, or they can be born out of a desire to move towards something. I happen to be a person who is primarily motivated to move away from something. I grew up in a wealthy part of Denmark, and I attended a school for the well-to-do. Then my parents divorced, and I went from living in a big house with an enormous garden to living in a one-bedroom flat, where my father would sleep on a pull-out sofa bed in the living room. I was a young boy at a time when all my school friends wore Levi's denims and Lacoste shirts. There was no money for that in my life, and it created a sense of inferiority in me. As soon as I was old enough, I started taking after-school jobs in order to earn money. What did I spend it on? You guessed it. Brand clothes. I also became a prolific hoarder of money, a saver, if you like. I took great pride in depositing my wage checks in the bank and seeing my account balance grow. I moved away from poverty. In my belief system and in my experience, away-oriented goal setting is a much stronger motivational force than towards-oriented, but I accept that this is an individual preference. You can test for yourself where your preference lies, using a simplistic scenario. What would compel you to lose weight more? A picture of you in perfect shape or a picture of you where you are obese? I asked my circle of friends what they would prefer, and all agreed that they would find the obese picture a stronger motivator than the perfect picture, although a few did comment that they would probably still like to have both. Fair point. I believe that disgust is a much stronger emotion than joy or happiness. We all have reasons to be happy every day, but we tend to forget that. However, disgust is not something we are likely to forget. You won't forget the rotten milk you drank by mistake, nor will you forget the client of yours who had such repugnant breath that you nearly threw up. Ed Seikoda once said that everybody gets what they want from the markets. When I read that, I dismissed it. I wanted to win, but I wasn't winning, so I clearly wasn't getting what I wanted. End of story. It annoyed me that he had said that. The thought of never being able to trade profitably consumed me. I had spent so much time studying, researching, testing, formulating plans, calculating ratios that I really didn't know what more I could do. If you look around in your life, you are likely to be able to find examples of dramatic changes induced by disgust. What gets a person to finally commit to a goal is reaching the point of disgust. I got disgusted with my trading over a long period of time. The pattern was always the same. 1. Trade like a wizard. 2. Become overconfident. 3. Blow up the account. I became so sick of it. Positive intentions, sticky notes with mantras on my trading monitor, and self-help exercises don't possess nearly the motivational force of physical disgust with oneself. If disgust can turn eating into a behavior to be avoided, and if disgust can turn an alcoholic's drinking into a thing of the past, then disgust can also turn you into the trader you would be proud of looking at in the mirror. I am sorry if I have shocked you. Those of you who know me well will probably be taken back by my extreme steps to ensure my pattern of behavior in the trading arena is exemplary. I am not going back to the roller coaster ride I was on in my early trading days. I was so disgusted with the amount of money I lost. It was embarrassing. We are most apt to change a pattern once we become truly disgusted by it. Would you continue to do business with someone who violated your trust and stole money from you? No. You'd become so disgusted with such a dishonest character that you would cut all ties with them. Well, that person is you when your own patterns violate your contract with yourself and cause you to lose money consistently. Once you become truly disgusted with your own patterns, you'll shun them altogether. A trader is losing and continues to lose because he doesn't want to change. Change is hard work. I began plotting my trades on the chart when the day was over. I put a marker where my entry was and where my exit was. It was horrible. It was like incriminating yourself over and over. I was disgusted with my recklessness. I had to face up to the fact that I was actually an awful trader. I was like the guy who could recite the entire technical analysis syllabus for the master technician exam, but I could not stop myself from 1. Overtrading out of boredom. 2. Overtrading out of anger and a desire to get revenge. 3. Impatient trading, jumping the gun. 4. Trading against the trend, trying to catch the low of the day. 5. Fearful trading. By cutting my winners short out of fear the profit would disappear. 6. Constantly averaging in lower and lower, i.e., adding to losing trades. Alcohol. When you are a successful trader, you make good money. My friend and trader mentor Larry Pesavento instilled in me the passion for passing on. Larry himself is an inspiring trader, but his passion for helping others is equally admirable. One project I support is to help people dealing with alcohol issues. I do so by offering anyone who sincerely desires to quit drinking a book that helped me truly understand the nature of the addiction trap. I developed a drinking problem in the aftermath of a painful breakup. I drank to forget. I was in love. I was a fool. She left me. I started drinking. The problem was that I didn't seem to be able to stop myself from drinking. This carried on for many months. I could not stop myself from drinking, so I sought out help. I remember vividly standing up at an Alcoholics Anonymous meeting saying, "My name is Tom Hugard. I am an alcoholic." It was horrible, but at the same time it was relieving. I felt like a fraud. I felt there was inconsistency in my life. I was outwardly a success. I had 2 cars. One was a luxury SUV, the other an Audi R8. I lived in a nice part of town, overlooking the sea. What did I have to be unhappy about? Well, for one, I had no control over myself and my drinking. Standing at an AA meeting is like being stripped naked for the whole world to see. They see your fat ass, your tiny willy, your saggy boobs, your cellulite, your scars, your spots, your pimples, your swellings, your bald head and whatever bodily imperfections you can imagine. It is absolutely everything you don't want, and you have a hall full of eyes watching you. But by the end of the exercise you realize the truth. You break yourself down so that you can survive, so that you can be reborn as the person that you really want to be. A fresh start, vanity thrown on the rubbish pile. Clean canvas. Here I am. This is me. The walls are ready to be decorated however you want. Exactly the same model is used to train elite soldiers. They are pushed beyond their breaking point. Then they are put back together again, stronger, wiser, and with an unshakable faith in their own strength, their own abilities, and their determination to get a job done, no matter what. No one in their right mind enjoys exposing themselves like this. It is why we get defensive. It is why we fight our corner. Our identity is being questioned. Call it ego, call it identity, call it what you want, but no one likes having their intelligence questioned. It is a lot less painful to continue down the known path than to stop, evaluate, and turn around. There is only a slight, nagging pain when you choose to continue down the known path, and you can soothe your inner pain by reminding yourself that you are not alone. There is power in numbers, even when everyone is wrong. But you soon find yourself being disgusted by your own lack of progress, your own inability to stop the behavior that is troubling you. Attending AA meetings was rock bottom for me. I evaluated. I got honest with myself. The pain was relentless because everything was new, and I felt naked, very alone and exposed. And yet, that is power. There is power in being honest. There is power in standing up and saying to the world and yourself, "This is who I am, and I don't like it. In fact, I hate it. I am embarrassed by it, but it is what it is." It is a clean slate. It is a fresh start. It is like a forest fire. It clears the debris. New growth can start. I have not touched alcohol for 6 years, and I know I never will. It wasn't the awe that finally helped me. It was healthy living advocate Jason Vale. I have never met the man, but I want to thank him for setting my life on a good path. I am certain that no one has bought more copies of his book about alcohol dependency than I have. I send them to people all over the world. Jason describes better than anyone the trap of alcohol. Reading his book helped me understand the nature of addiction on an entirely different level, and I found it easy to stop drinking from day one. You may ask what this has to do with trading. Rightly so. The answer is simple. If you have some trading experience, and it is not turning out to be how you want it to be, you have a choice. You can carry on, thinking that things will change. I can tell you they won't, but you will probably not listen to me. Or you can take my advice. You did, after all, make it all the way to this section of the book, so maybe there is room for improvement. You can strip yourself naked, metaphorically speaking, and get honest with yourself. You can stop trading and start reviewing. You can begin to understand what it is you are consistently doing that causes you not to make money trading. Take yourself apart, clean up the process, take on board my guidance for the mental side of trading, put yourself back together again, fund a small account, and start with an entirely fresh mindset and approach. The drifter mind. How our minds work is fascinating. The brain can be our best friend or our worst enemy. When I give talks in public, my own life mantra is written on virtually every PowerPoint page of any presentation I give. Control your mind, control your future. You have to want to do what you do. You can live a life that is authentic to your soul, or you can live the life you think people want you to live. You can be authentic and own your life and take responsibility for everything you do. If you don't take ownership of your life, you are not the boss. You have to take full responsibility for everything that you do. Why would you live life any other way? Why be subservient? You must be the master of your own kingdom. But brace yourself. You will be forced to make many difficult decisions, and you cannot count on your mind to back you up if your determination wanders a little. You can't just walk through your life with your eyes half open. You have to know where you are going. You have to take possession of your life. It would be nice if you could rely on your friends and family, but when it comes to your life's journey, you are on your own. It is your responsibility. Part of that journey, including your trading journey, is to discover your weaknesses. You have to know where your mind lets you down. For the vast majority of people in the world, this will include their mind's tendency to wander. You see, all of us know what to do. All of us have the knowledge to do what needs to be done, but the path from knowledge to action, where we implement our knowledge, is elusive for many people in many areas of their lives. Your mind will drift. This is unfortunate but perfectly natural. The solution is trivial, and it is powerful. You have to constantly reaffirm your purpose. Whether you meditate or talk to yourself while you brush your teeth in the morning, there needs to be some period in your day when you remember your purpose. There must be a time to remind yourself where you want to go, what you want to do. One thing I can't always rely on is my ability to act in my own best self-interest. My mind needs constant guidance and direction. I don't know why that is, but it is. I suspect the majority of the population of the planet is put together like I am. They just haven't realized it yet, so they drift through life, rather than taking charge. This doesn't mean they can't be financially successful, but wouldn't it be nice to be both financially and spiritually fulfilled? Your job, after all, is that thing that you do the most, outside of sleeping. I am a professional trader. I cannot afford to go into the trading ring without being 100% mentally prepared. My profession is a mind game like nothing else. If I want to win, I have to focus on what is important now. So Ed Seykota was right, much to my chagrin. I did get what I deserved, because I was only good at one part of the game. I was good at the technical part. I don't like this metaphor, but being good at the technical part of trading is like being good at putting together a sniper rifle. What good does that do you when you go into combat and you don't know how to handle yourself? I actively take control of my inner world. I have to give myself enough confidence to reassure myself that I have enough to go out and kick ass in the markets every day. To make that challenge even more real, I post my trades for the world to see. I have never consciously thought about why I do that, until someone recently asked me. I realized that I do it because it keeps me accountable. It keeps me focused. I have been as lost as they come. I tell you that not to inspire you to get lost, nor to evoke sympathy, nor to tell a tale of rags to riches, but to make sure you understand that exposing your weaknesses will be a good thing. Your mind is a tool. If you let it delude you into thinking all is well, you will not get the success you want in trading or in life. Losing and failing might be a knock to the ego, but it is rocket fuel for growth. It sounds like I am trying to write a self-help manual for procrastination, a best-selling inspirational book. But I am describing honesty. When you are honest with yourself, in the company of yourself, or on a podium in front of 40 alcoholics, or whatever the setting may be, you just took a step that 99% of the population don't ever contemplate taking. You already started the journey to winning. So, the journey starts with technical knowledge acquisition and continues indefinitely with the constant evolution of both the technical and mental training. Technical training is part of my day-to-day job, but the mental part needs more dedicated focus, otherwise it gets lost in the noise of the outside world. I need dedicated time to give that brain of mine a workout. I want to show you one of the mental warm-up images that I go through before the trading day starts. It gives me the visual evidence I need to act in a manner that is aligned with what I am trying to achieve. This example happened a while ago, but it could happen any day of the week if I don't mentally prepare myself. Figure 23 tells the tale in all its glory. I short a double top off the open. I am so certain that my research is right. The market will fall. I don't have a problem with the first short position. I have a problem with the 4 subsequent ones. I could even forgive myself for the last one, because at least I am shorting weakness. This is unstructured and undisciplined trading. I don't care how certain I am of something happening. If it isn't happening, don't pursue it as if it is. Showing you is so embarrassing. This is part of my preparation. It has been the most useful tool to build mental stamina and discipline. It reminds me of everything that is weak in me. It reminds me of how my mind, if left unchecked and untrained, will go on a rampage to seek excitement and gratification. One of the best ways to increase profits is to use goal setting and visualizations to align the conscious and subconscious with making profits. I use fear to achieve my goals. I imagine trading a size which even in my mind makes me uncomfortable. I sit quietly in my bed or in my office. The world is quiet, and if it isn't, I stick a pair of earplugs in my ears. I imagine I am trading, and the market is moving against me. I see myself cut the loss. I imagine I bought the XYZ, and I see it going my way. I feel the brain sending me signals to close the position to crystallize the profit. I see myself doing nothing, as I continue to watch the profit increase and decrease. I see a big profit turn into a small profit. I smile and accept it, and I move on, telling myself it is okay. I place my brain under as much stress as I can with imagined scenarios. I am long and the market is going my way, and a sudden news story breaks the market. I observe my fear shooting through the roof as my P&L turns into a bloodbath. I see myself closing the positions and going in the opposite direction. I see myself not getting unhinged just because the market is moving against me. I cannot guarantee that this approach will work for everyone. Perhaps you think it is brilliant, or at least could be useful after a few personal tweaks. It works for me because I learn visually. I get the message when I see it visually. If you tell me not to trade against the trend, it will not mean any more to me than when a cat meows. But show me a chart with my trades plotted on, with me trading against the trend, better yet, show me repeatedly, and I get the message. This is my therapy. This is like seeing a psychologist every morning. I get fired up. The therapist expands my mind and my horizon. The goal is to remind myself of what behavior I want to enact. It is about making changes and keeping the changes. So what makes me think this will work for you? Behavior is patterned. How we think, feel, and act has a pattern to it, and that patterning is what makes us who we are. The sum total of our patterns is our personality. Sometimes our patterns interfere with our goals and dreams in life. They prevent us from being who we want to be or accomplishing what we want to accomplish. We are sometimes our own worst enemy, and we seemingly can't stop ourselves when we are in the moment. A person can know very well that they have anger issues, and yet be unable to prevent themselves from lashing out. Another might have eating issues, and yet can't exercise the needed restraint in the moment of eating. A trader is fighting the trend all day and his account is suffering, but he can't stop himself. He is simply incapable of turning his position and trade in the direction of the trend. Only afterwards is he disgusted with himself. The purpose of my warm-up is not to take away everything that is bad in our lives in one swift move. The purpose is not to guarantee I won't mess up. The purpose is to focus on what I want to achieve or become, while being mindful of the things that will most certainly sabotage my goals. The wonderful part is that I am almost certainly guaranteed success if I avoid the failures. I was guaranteed success with my weight goal if I could cut out all the Coca-Cola I drank. I just had to be mindful of that, and the pounds began to come off. I didn't have to do anything else. I don't have to be certain that my trade is going to work out. I just have to be aware that my mind wants to do things that are not in my own best interest. So, I don't add to my losing trades. That in itself means I just need to be mindful of the one variable I can control. My action in the morning is about changing the patterns that do not serve me. This started by observing another very successful trader and asking myself what was holding me back from becoming him. My technical abilities were just as good as his. I don't think he was financially much better off than I was, but he was seemingly fearless. How could I become fearless in trading? Did I even want to be fearless? I came to the conclusion that the trader I wanted to become was patient but aggressive when the time was right. It was like Federer playing in the Wimbledon final in 2007. He was patient until just the right moment, and then played with focused aggression. After that, it was a question of reminding myself of that goal every day, and several times a day if necessary. That is how habits are built, through repetition. As I grow wiser to the ways of life, I realize that there is a lot of truth to John Lennon's words. Life is what happens to you while you're busy making other plans. We become so engaged in our day-to-day life, with responsibilities at work and home, that the big picture of our lives stays in the background. Day after day, year after year, we busy ourselves with work and routines, only to realize later in life that opportunities have passed us by. So, the first question to address in a change process is, what do you want to change? Or, stated otherwise, how would you like your life to be different? My answer? I want to dedicate time to trading well, to combat my natural inclinations that stand between me and successful trading. I want to prepare my mind every morning through a series of meditations and visual exercises. To achieve this, I will train my mind to act calmly through visualizing myself in difficult situations. I will focus on my breath. I will calmly put myself through stressful situations to ensure I would react how I want to react if the circumstances were real. Making changes entails far more than simply engaging in positive thinking or getting positive images in your head. I didn't want positive images. I wanted a portrait of the dire hell I would reside in if I didn't change. This may seem like a negative state of being, but it really isn't. It is immensely positive, albeit a rather tense way of getting what you want. As the saying goes, the end justifies the means. I have turned conventional thinking on its head. I do so because I know what compels me more. Roses don't compel me. Thorns compel me to action. Consider the market itself. It is not so unlike us in its behavior, because we are the market. It climbs the wall of worry, but it slides down the slope of hope. It might be a Wall Street saying, but it says a whole lot more about humans than it says about the markets. All I have done is used fear and disgust as my protagonist, my major motivator. Getting back in the game. I was surfing in a town outside Biarritz, France, in 1996. I was literally in over my head. The waves were twice as big as anything I had ever handled before. I tried to drop in a few times, but the waves were too fast, and the lip was so steep. Finally, I got myself positioned for a wave, but I was too far into the impact zone, and instead of gliding into the energy path of the wave, it literally knocked me out. I just remember everything going black. Luckily for me, someone spotted me and pulled me out of the water. 8 lives left. I was back in the water that afternoon. I was too stupid and ignorant to consider what had happened. Ignorance is bliss. It is only now that I can appreciate my behavior. Sure, you took a hit, but you are okay. Do you want to sit on the beach and mope all day, or do you want to get back in the game? Here's an example illustrating the importance of getting back in the game. I am writing this the day after a particularly challenging and volatile trading session. It was one of those days that will stick in your mind for reasons that will shortly become apparent. Over the last week, oil has dictated the mood of the stock indices. Naturally, I expected to see the same behavior on Friday. The Dow started off with a 200-point rally at the open. However, 30 minutes into the trading session, it seemed to lose momentum. Oil, on the other hand, was in full-blown panic. I started shorting Dow, expecting it to follow oil. In Figure 24, Dow is on the left, and oil is on the right. Both are 5-minute charts, and both show the entirety of the trading session from about noon until late evening. I expected the Dow to follow oil, and it did, but not for long. It seemed to pause, as if it suddenly had a mind of its own. By mid-afternoon, oil had dropped almost $2, more than 5% in little over an hour. The Dow, however, wasn't moving lower with it. It held. I took my Dow short position off with a loss, and I reversed to long. As soon as I had done that, the Dow dropped 50 points, and oil dropped even lower. I began to wonder if I had simply been too quick to reverse my position, and I decided to close my long position. By now, I was convinced the Dow had merely delayed its inevitable fall. I went short again. In hindsight, that turned out to be near the low of the day, after the open. Just 15 minutes later, the Dow made new highs for the day. I closed my short position and scratched my head. I had gone short at the first low, and I had closed at the second high. I had gone long at the second high, and I had closed at the second low. I had gone short at the second low, and I had just stopped myself out at the new highs for the day. I took a moment to reflect. Was I trading with a plan? Was I betting on a relationship between oil and the Dow index that might not be there anymore? Just then my best trader friend called, and we spoke briefly. I said to him, "What does it mean when the Dow makes new highs on a Friday evening, even though oil is plummeting?" Saying it out loud helped me to get some perspective. It was the last day of the month, which often brings aggressive buying or selling in the market. Remember, it was also a Friday, which has a tendency to bring about trend days. I started buying, reluctantly. The market went higher. I bought some more, careful to move the stop loss up as the markets moved higher. I kept an eye on oil. It was recovering nicely. With 60 minutes to go, and no dinner, the Dow made a new high for the day, and I know from my statistics that you should not short a market that makes new highs for the day in the final hour. By then I began to add more to my position. I was now betting on a classic trend day finish. On those days, the market closes right at the high tick of the day. It would have been easy to throw in the towel after the 3 failed attempts to get on board a move in the market. The effect would have been the same as stopping the game of throwing coins just because you have had 3 of a kind in a row. I hear about people who stop trading because they have 3 losing trades in a row. That is a flawed approach if you understand the markets. If you are ill, or you are weighed down by emotional circumstances, then you stop trading. If you are otherwise able, you don't stop trading just because you have lost 3 times in a row. As I type this, I look back at my trading before the Friday. I had lost on every other day that week. It is rare, but I had 4 losing days in a row. I don't even remember when that last happened. In the movie Floored, the trader Greg Reba puts it so elegantly, albeit in his own way. I swear to God that 99% still don't get it. When they are winning, they start betting less. Bet more. I mean, if there is one roll that you can make $100,000 on, let it ride. If you roll 3 sixes in a row, let it ride. Let the winners ride. Greg Reba should know. He was said to be one of the best S&P 500 futures pit traders ever. Why do people bet less when they are winning and bet more when they are losing? Fear. Trading through slump. I have a friend who was suicidal because of the losses he sustained. He called me to say that he was standing at a railroad bridge. I don't think it was his intention to end his life. I think he needed someone to talk to. Some would argue that a chapter of this nature does not belong in a trading book. I think people who have lost significant amounts of money will find it reassuring that the focus isn't one-sided. Either way, while I have plenty of positive memories from my trading career, I also have memories that can only be described as dark. I had a friend called Adam. I no longer know of his whereabouts. He owes me £20,000 money I doubt I will ever see. Adam was a brilliant trader. Absolutely brilliant until it all unraveled for him. Adam and his brother worked on the factory floor for their father's thriving business. During the 1990s, Adam became interested in trading. Over the ensuing years, he developed a system for trading stock indices using a 30-minute chart. He told me it was inspired in part by George Taylor's book, The Taylor Trading Technique. It was a simple but very effective strategy. It required Adam to check the charts every 30 minutes, and if the parameters were right, he would execute a trade. Otherwise, he would leave it alone until the next 30-minute period was up, at which point he would check the charts again. Adam became so adept at trading the 30-minute chart that he soon made much more money trading than he did managing his father's factory. He decided to sell his share of the factory to his brother and focus all his energy on trading. Adam did well. Really well. I traded with Adam on many occasions in my house or online. He possessed a supernatural patience. I have personally never seen a person stare at a screen from the open of the US market to the close of the US market and not trade once. Yet that was the norm for Adam if there was no signal. Amazing patience. I believe that Adam's patience and pattern reading ability made him the super trader that he was. He lived the life of the super trader too. He ordered a custom-built house. He traveled first class to exotic holiday destinations with his loving wife and children. However, all super traders will go through bumpy terrain at some point or another. It is not a question of if it will happen, because it will, but a question of how badly it will affect them when it inevitably does. For Adam, the bumpy road caused him to lose everything. His trading account, his wife and his house. I stepped in when Adam was living on the streets in Manchester, suicidal and penniless. I did what I could, but Adam didn't want my help, and I lost contact with him. It started with a bad loss, and it escalated into a complete blowout. Adam had seen a pattern on a Friday night, and he had gone maximum short the market. At the close, he was well in the money, and he decided to keep the position over the weekend. Unfortunately for Adam, this was the weekend when the American Special Forces finally captured Saddam Hussein. The financial markets cheered at the good news. I guess naively they thought that the Middle East powder keg would settle down once Saddam had been captured. That Sunday night, the American markets opened limit up. Limit up is a situation where the market is unable to move any higher until the stock market opens at 9:30 a.m. in New York. Adam was short, but he was unable to close his short position because when the market is limit up you can't buy, which is what you need to do to close a short position. Adam was awake when the phone call came. It was his futures broker. Adam was informed of his options: deposit more money on the account or risk being closed out once the future market came out of limit up. Adam didn't have any available capital. It was a long night and a long day until the market finally opened at 2:30 a.m. Adam lived in the UK. The market opened and stocks soared. The broker liquidated his position because he was in breach of the margin requirement. The account had stood at close to £750,000. Now there was only £400,000 on the account. You may say that £400,000 is also a decent pot of money to trade with, but something short-circuited in his mind. He saw the market soar that day, and he saw his position being liquidated. Unfortunately, he also saw how the market came all the way back to his entry point. You see, once the good news had been digested by the market, there was a feeling that this probably wasn't such great news after all. The Dow index came all the way back, giving up all the gains for the day. Adam felt the broker had cheated him. He felt as if he had been forced to liquidate. He felt that the broker had acted too hastily. He tried to complain, but his claim was rejected. He then tried to make up for the lost money through trading, but his head wasn't right. He began to second-guess his system and double up on trades. Then his builder demanded payment for his house. Adam had paid a deposit, but now he couldn't make full and final payment. He lost the deposit and the house. Adam was unable to stop his own downfall. So was his family. He began a pattern of lying and withholding information for his own gain. The last time I heard from Adam was when he cheated me out of a fair sum of money, only to disappear. I haven't seen him since. Sadly, this is not an isolated story. I have had to cut short a business trip while working in London because my boss called me back to the office. There was a client in our reception crying his eyes out because he had lost £750,000 trading Forex. He was afraid to go home and tell his wife about it. He begged my boss to lend him money so that he could trade again and hopefully make the money back. You may think that this individual lacks the moral fortitude to trade. You may even think less of him because of his apparent lack of dignity. What if I were to tell you that he was a renowned surgeon in a prestigious private London clinic? Education means very little in this industry. It doesn't matter where you went to school or what your day job is. If you don't know how to handle a losing trade, and then a winning trade, you will not go very far in this arena. It is for this reason that I tell people to spend less time on technical analysis and more time on self-analysis. Successful trading can mean just making a good living. I got a message from a close friend of mine. He trades full-time. He has been doing it for 15 years and, unlike so many other hopefuls, managed to make a success of it. He has made himself a good living over the years. I don't know many traders who like to talk about what they earn from their trading. When I spoke to my friend about it, he told me he had made about the same as if he had a well-paid managerial job in the city. However, he had no commute, and he had time to be there for his children when they came home from school. To me, my friend is an example of a person who made trading work for him. He had not made himself rich in the process, but he had paid the bills, put food on the table for his family, taken them on holidays, and bought a nice family car. There seems to be an inclination to describe trading as the venue for making untold riches. Yes, the potential is always there, but with bigger reward comes bigger risk. You can't catch big fish in shallow waters. However, my friend was tiring from the long hours, and he called me to talk. He asked me if I had ever had enough of the endless hours of watching the screens. I immediately responded, no, and if you feel like that, you have to stop trading and take a break from it all. We spoke for a while that night on the phone. He told me that now that the kids were older, they wanted to hang out with friends rather than their old dad. His wife worked full-time too. It meant he was often alone in the house from early morning until later afternoon, and it began to bother him. I helped him get a few job interviews and he secured himself a job as a broker in London, on account of his in-depth understanding of the markets and his ability to understand what clients are going through in their trading. A fairly innocent story, I am sure you would argue. So why am I telling you about my friend? Well, I am telling you the story for several reasons. The first reason is that trading can be a very lonely business. It has never bothered me, but I have the deepest of sympathy for those who feel lonely while trading. I am not sociable, don't drink or smoke, can't stand watching a football match, that excludes me from a lot of male social activities, and prefer my own company. But even I like to pick up the phone from time to time and just shoot the breeze with a friend. When I worked in the city, I would at times stick my head into my boss's office, who always had a minute to say hi and catch up on life. If you one day decide to make a go of trading full-time, you may experience a twinge of sadness that you no longer have the odd chat with a work colleague. I recommend that you take a week or two's holiday and try full-time trading before you hand in your notice to your boss and begin your full-time online trading job. It will give you a taster of what your day will look like. The second reason I told you the story about my friend is to make sure you realize that a pause from trading is not the end of trading. The markets will always be there. My friend will no doubt be back to trading full-time one day. In the meantime, he is enjoying a new life where he is helping others achieve what they want from trading. The third reason I am telling you this story is because I would love to see you succeed, but I think it is important you understand that trading may not offer you the rainbow you had hoped for. But does it have to? Could it not just offer you a good income, where you are working on your own terms and perhaps doing something that you find immensely interesting? Does it have to result in owning a beachfront property in Barbados? Sure. If you get there, I am happy for you, and you should be proud of yourself. However, if you don't get there, but you still manage to pay your bills and put money aside for the sweet things in life as if you were the recipient of a monthly paycheck, then Tom, you have done what the 99% of the population do not dare to do. They dare not take a chance on their dreams. If you can make a living from it, be it a decent living or a great living, then you really are something out of the ordinary. And trust me when I say that once you understand trading better, you will also come to understand what makes you work optimally in the trading arena, and that is when being a trader gets really fun. 8 months ago, I went through a tough time. It happened during the month of May. I started strongly, and then the wheels started falling off. I was up some £200,000 on the month, and it started to unravel. It started with a loss of £33,000. Often when I have a bad day, I will come roaring back the day after, but I didn't. I lost another £9,000 the day after. Then came the weekend, not a moment too soon. Monday started where Friday had left off, in spite of all my preparation and introspection over the weekend. I lost another £38,000. Before the week was over, I had lost more than 50% of the gains for the month. More disturbingly, I felt completely lost. I had no idea why I was losing. I wasn't tired. I was sleeping well. I had no emotional issues that occupied my focus. I was just not performing. I have endured hard times before. Progress has at times been slow. Setbacks have been frequent. Setbacks are always lurking. My goal is to stay in the game until I don't want to spend all my waking mental energy on the markets. As you can perhaps gather, this is a deeply personal journey for me. It is often a mentally draining journey, where I feel I am not making any progress. What made it worse for me was that a really good friend of mine, also a trader, and probably the best private trader the world has never heard of, was having a great run. We have always been brutally honest with each other. I think therein lies the strength of our friendship. I will tell him point blank, I am jealous of you. I feel bad that I am jealous of you, because you are my closest friend, and I would give you my last dollar, but right now I am shooting blanks. I am hemorrhaging money. I told him I had a huge position on. It was literally the biggest position I have ever carried. Each point was worth £4,000. That equates to 400 FTSE futures contracts. I was so certain the FTSE would fall. I have seen the pattern so many times. Big fall off the open 2 to 3 bars of 5-minute duration of rebound, and then new lows. But it didn't. Not that day. It rallied. And he was long. I was short. It was immensely painful. It took me to a place I didn't want to visit. A place of envy, resentment, and despair. You know, Tom, you are lucky. My thoughts were interrupted by my girlfriend. It was as if she knew what I was thinking. Not everyone has someone who is better than them, and who they stay up at night wondering how to beat. Not everyone is Mozart versus Salieri. You should be happy. So you lost. But what have you gained? Don't you know that he feels the same as you do? He desperately wants to beat you, for no other reason that you bring out the best in each other. She carried on. You know, my old Professor Peel, I told you about him. Brilliant man. Do you know what made him brilliant? His colleague, Professor Kyle. They were best friends and neither of them would ever acknowledge that they were insanely jealous of each other, yet they were the two most brilliant minds anyone could wish to learn from. You should really count your blessings that you have someone who you so badly want to beat. It is really not a curse. It is a blessing. What do you think would happen if your idols stopped trading? If they stopped, I thought, who would I beat then? I always loved beating my old high score, and I did today, in size, but she was right. I am not just trading to make money. I am trading to push myself into those places where I am not comfortable. I was once in a restaurant in Porto Cristo, having dinner with my son. I happened to look over my shoulder and I saw Rafa Nadal having a late meal with his friends. It was great to witness a world-famous tennis star just shooting the breeze with his old friends. A few days later we visited his tennis academy. Rafa was training. It was hot as hell that day. He trained like his life depended on it. He was out there pouring his heart out in the blazing heat just to get better. Why do you think he was doing that? It is for the same reason that someone like Matthew McConaughey, during his Oscar acceptance speech in 2014 said, "There are 3 things that I need each day. 1. I need something to look up to. 2. I need something to look forward to. 3. I need something to chase." I am writing this because I think being open about what drives us is healthy. There will come a point in your career as a financial trader where you will go through a slump. When it happens, it might serve you well to step back and think deeply about why you are so drawn to this game. And when it happens, I hope you will turn to these pages. I hope they will remind you why you are doing what you are doing. What my slump taught me was to slow down. If you do not slow down and let the knowledge mature, then you will take a huge loss, which will dent your confidence. Not every trade is the World Cup final. Not every trading session is the final exam of the final year, the culmination of 4 years of relentless studies. Everyone has setbacks. Kobe, Rafa, Federer, you, me, and all slumps end. Slumps are inevitable. You are bearish and the market goes up. You are bullish, the market goes down. It happens to us all. Every one of us. Is there a key to escaping a slump? No. Why should I throw old, worn cliches at you? Why should I tell you to stay calm and work your way through it? Why don't I just tell you that it is horrible to go through, but it will end if you persist? I wrote this chapter over several weeks. When I started it, I was not in a slump. Then the slump arrived, and I described it. As I type these words, I have had a fantastic trading morning. Am I out of the slump? Who knows? I do not know what I am doing differently to what I did when the slump set in. I am simply following the process I always follow. I am a process-oriented trader. The markets determine the outcome. I have little control over that. I have faith. I believe that my process will carry me through the highs and the lows of trading. Embracing failure. The late Mark Douglas argued that successful trading is a question of accepting risk and thinking differently. The market wizard trader Ed Seykota put it another way. A losing trader can do little to transform himself into a winning trader. A losing trader is not going to want to transform himself. That's the kind of thing winning traders do. When I read that passage the first time, I was not mature enough to understand its importance. When I started trading for myself, I began to appreciate its depth and wisdom. As I began trading bigger and bigger size, I realized that my journey from a low-stakes trader to a high-stakes trader was not the result of evolution. Sure, I got better the more I traded, but remember this, practice does not make perfect. It merely makes it permanent. Only through a dedicated approach to practice, with a specific attention to finding your mistakes, will you improve. Otherwise, you are just cementing your unprofitable behavior. Becoming a different person, being anxious and fearful, is a reflection of an unknown situation. Through exposure, over and over, our minds come to accept the new reality, and through that exposure become accustomed to it. You think there is a hack that will all of a sudden take you from trading 10 pounds a point to 100 pounds a point? You think there is some book you can read, or some course you can take, or a pill you can ingest that will take you from being an average stake trader to a high stake trader. Well, not quite. But there are certainly ways you can accelerate your progress. It is a question of priority. I am not some hardcore monk with no life and a never-ending commitment to pushing myself into those cold, dark corners where I dance with uncertainty until my emotions are stunted and I essentially become a psychopath with no fear. But I am committed. I want to explore my weaknesses. I am reasonably attuned to my mind and body, and I know that left to my own devices I can quickly spiral into self-destructive behavior. I had a painful breakup with a loved one, and I turned to food and alcohol. Sure, I think we all do things like that. Even Bridget Jones, I love movies, ate her way through a tub of ice cream in one sitting when she was dumped by the love of her life. But you move on. You get off the sofa. You turn off the TV and throw the ice cream bucket in the bin, and you say, okay, so I made a mistake. I will own it. How you feel about failure will to a very large degree define your growth and the trajectory of virtually every aspect of your life. You may want to close the book and think about that for a while. It is quite frightening how deep that sentence is. A significant part of your success as a trader is correlated to your relationship with failing. If you see failure as the end game, then you won't make it as a trader. I have colleagues who will stop trading if they have 3 losing trades in a row. What kind of attitude is that? You think Kobe Bryant, the absolute Superman of basketball, had that attitude? You think during a game he would make 3 misses and then ask the coach to be replaced by someone else? Kobe Bryant, the biggest failure. While we are on the topic of Kobe Bryant, I want to tell you a story about him, which I read in a paper, sadly after Kobe passed away in a tragic accident. After the accident, most obituaries focused on Bryant's amazing achievements and trophies won, but Andy Bull from The Guardian wrote about Kobe Bryant from a different vantage point. The headline of the article sums it up well. Bryant's success story began with working to conquer the fear of failure. It seems Kobe Bryant intuitively knew that, in order to be a great player, he needed to conquer his fear of failing. The article goes on to tell the story of a game in May 1997. It was Kobe's first season for the LA Lakers, his rookie season. He made 4 crucial errors inside 5 minutes, which some say cost his team the game. That night, the story goes, Bryant stayed up shooting hoops privately and alone. He was still at it when the sun came up. I know this feels a little sugar-sweet. It has a David versus Goliath feel to it. But there is more to this than meets the eye. On the surface, it reads that Kobe Bryant was beaten in that game and he followed it with a punishing all-night session. To me, the story tells of a man who night after night confronted his fear of failure by repeatedly trying. He became used to sometimes failing temporarily, and yet he kept at it. Bull concludes by saying, he missed more shots than any other player in history. Bryant was willing to encounter failure in every game he played. It is not the first story I have read about an all-American great, someone who confronted the fear of being wrong, in order to be proven right. Babe Ruth, the American baseball player, held home run records for decades. At the same time, he went by the nickname King of Strikeouts. If the term itself doesn't give it away, let me explain. A home run is great. A strikeout is the very opposite. I found the story resonated with traders all over the world who seek out systems and strategies aimed at eliminating losing trades. As I write this on a quiet trading day on the 1st of June 2020, I look over my trading statistics for the month of May. I made a total of 1,513 points. Yet out of the 137 trades I executed, I lost on 66 of them, won on 53 of them, and broke even on 18 of them, where stop loss was moved to entry point. If I gauged my success according to some of the hyped-up system sellers on the internet who promise a 95% or better hit rate on trades, I am an abject failure. I mean, I was less than 50-50 in May. Yet, somehow, I still managed to make a decent return for the month. How do you explain that? The answer is found in the erroneous belief that the more winning trades you have, the better a trader you are. That is plainly and simply wrong. One of the popular cliches in the trading world is that you can't go broke taking a profit. Oh, hell yes you can. If you are unable to let your profits run, you will never make money trading. While basketball and trading differ on this point, if I were afraid to lose, I would never have had a profitable month. Statistics do not make sense. We know that 90% of traders lose. We also know from the FX trading sample of 25,000 traders that most trading accounts have more winning trades than losing trades. This does not make sense. How can we reconcile those two facts? The answer is found if you read between the lines of the story of Kobe Bryant. If you are in a losing position, you are essentially wrong. However, unlike a shot in a basketball game, where you immediately know when you are right or wrong, in trading there is always the hope that the trade will come back in your favor. Hope is what keeps people in trades long after they should have closed them. As the saying goes, hope dies last. So true, and so detrimental to traders. How do I deal with hope and fear in my trading? I tend to only feel hope when I am in a trade. I hope my position will come good. I hope the market will move in my favor. Fear, however, is felt in more situations. I can feel fear when I am in a trade. But I can also feel fear when I am not in a trade. That is a subtle but important distinction between hope and fear. Hope tends to be reserved for the activity of being in the trade, while fear manifests itself both when I am in a trade and when I am not in a trade. I can be fearful that the market will move ahead without me, or I can be afraid that I have closed my position too soon, which could also rightly be classified as regret. While I intend to write in much more depth about my trading regime at the end of the book, I will describe my approach briefly now. I deal with fear when I am in a trade by having an exit strategy. I have a stop loss, which defines the size of my loss. I have accepted this loss before I started the trading day. It is part of my trading plan. I will have mentally prepared in the morning, ahead of the trading day. I will have sat quietly, contemplating what I am about to do. I will have subjected my mind to images of me losing. I will have calmed my mind, when it experienced these imagined losses, so as to negotiate away any feelings of anxiety and regret, as well as desires to get revenge and get even. I will have dealt with hope by accepting that my stop loss will define my exit. Maybe I will win. Maybe I will not win. Before the trading day started, I will have gone through mental exercises that saw me enter the market, observe the market move against me, negotiate with my fear brain and the impulse urges it sent to my conscious awareness. By the start of the trading day, I will already have seen myself win and lose, add to positions, and patiently wait for the right setup. By the time the bell rings, opening the market for trading, I am mentally warmed up. I am ready to fail without losing my composure. My competitive son. I have a fascination with reading about the lives of high-performance soldiers. I love reading about the trials and tribulations of the SAS and Navy SEALs. My son shares this interest. In particular, we are fascinated with the free diving part of the training. One of the obstacles that these elite warriors have to pass is the 50-meter underwater free dive. Do you think there is a shortcut to diving 50 meters underwater? Take it from someone who has swum 46 meters underwater, there is no shortcut. I practiced and practiced while on holiday with my son. There happened to a 50-meter swimming pool in the complex we were staying at. Being the competitive spirits that both my son and I are, he set out first on our initial attempt. He made it a little less than halfway. Now I had a goal, and I made it almost to the halfway line. I beat him by an inch or two. We spoke about how we could get better, and we agreed that we needed to focus more on our preparation before the swim. So next we sat on the edge of the pool, and we focused on filling our lungs with oxygen and oxygenating our bodies. Gradually we got better and better. Then we realized that if we swam less frantically while underwater, we would expend less oxygen. Our focus shifted to staying calm and taking rhythmic strokes. By the end of the 7-day holiday, I came within a few strokes of 50 meters. My son was a meter or two behind me. Passing this test is one of the major stumbling blocks for aspiring Navy SEALs. I am not saying that my son or I are Navy SEAL material, but I am saying that there is no way you are going to swim 50 meters underwater without relentless practice. We worked on it. Then we evaluated our process. We didn't actually focus on the outcome at all. We just did everything we could to make the process as efficient as possible. Does that remind you of something? If you have a goal that you want to make X amount of money a day, or a certain amount of pips or points, you might be sabotaging your chances of making a lot of money. You are outcome-oriented. You would benefit immensely from shifting your focus to being process-orientated. Best loser wins. The time has come to get more specific. We can skirt around the issue forever, or we can decide to get our hands dirty and get down to the business of creating a finely tuned trading mind. What you become in life is dependent on the decisions you make and how you react to decisions made on your behalf. At Stanford University, Steve Jobs, standing at the podium in front of the class of 2005, gave the new graduates their commencement speech, advice on how to live life. It went something like this: remembering that you're going to die is the best way I know to avoid the trap of thinking you have something to lose. You are already naked. There is no reason not to follow your heart. Few can walk the walk when money is on the line. The main contributor to not having the life you want is fear. Most play this game called life safely within the boundaries they set while growing up, boundaries built by avoiding pain and anxiety. I am often asked if I know the secret to becoming a good trader. I think many novices believe that I know some really good trading setups. They're not entirely wrong. Yes, I know some great setups, but they still only work, at best, about 70% of the time. I am still wrong 30 times out of 100. I am not where I am in the trading world because of my IQ. I'll tell you that immediately. I am here because of my relationship with pain. Our brains hate the idea of losing something that is valuable to us. The brain will abandon all rational thought and make some really poor decisions trying to avoid losing something that has value. I am a profitable trader. Is that because I possess superior charting abilities? No. Of course not. There are many brilliant chartists who can't trade. Is it because I have a superior system? No. There are many great systems, but most will still only have a 60% strike rate. Is it because I have friends in high places that feed me insider information? No. Did you not read my book? I am socially reclusive, and I certainly do not have friends in high places. I have no secrets. I have no special abilities, with the possible exception of one. Do you want to know why I am so good at trading? I am exceptionally good at losing. When speculating in financial markets, the best loser wins. Don't underestimate these 4 words. Though it may go against the conditioning that life and the modern world have programmed you with, success in financial market speculation is not about being the best, coming first, or winning. Instead, it's about losing. Your relationship with fear and adversity will to a very high degree define your life. And that's why I win. I win because I'm really good at losing. In trading, unlike life, it's the best loser that wins. Do you think a dentist or a doctor would be in business if they had a 60% win rate? Of course not. But a trader can thrive and prosper on that kind of success rate, as long as they are prepared for it. Most are not. Many are called. Trading attracts many people who shouldn't be traders. They are led to believe that trading is easy. Maybe a broker is tempting them. I'm sure you've seen the broker advertisements where a calm, confident actor knowingly pressing buttons in front of a bedazzling array of screens, then walks away victorious with a confident smirk. If you look at the trading industry, we are led to believe it is all about the tools. Hang on. Do you think I can play tennis like Roger Federer just because I have a Wilson Pro tennis racket? It's an illusion. How do I know? Because, for years, I was an insider working at one of the largest financial market brokers in London. Why do so many people lose? Statistically speaking, it should be impossible for so many people to lose. If the market is random, and most of the time, market movement is indeed random, why do 90% of clients consistently lose a 50-50 bet? The answer is as simple as it is complex. It isn't the market beating them. They are beating themselves. I wasn't always a successful trader either. To become successful, I had to break down the barrier that separates the many from the few, in a business where there is no instruction manual, and where the lesson comes after the test. It didn't take me long as a broker to notice our clients' trading behavior. As a group, traders are predictable. Or, more accurately, their outcome is predictable, because everyone is doing the same thing. I watched thousands of traders execute millions of trades. Their behavior became predictable, almost as if they were connected together in one hive mind. Week after week, month after month, year in, year out, when they were making a loss, they hoped the market would give them back their losses. Yet when they were making a profit, they feared the market would take it away. They were fearful when they should have been hopeful. They were hopeful when, in fact, they should have been fearful. These human experiences helped make me the trader I am today. Watching them struggle, I realized they were searching in the wrong place. The answer they were so desperate to find is not found in the external. It's not found in the software or in any of the tools. Instead, I realized, the answer is to be found inside the self. Tuning my mind. In the silence of the early morning, I'm in my office, preparing for the day's trading. It is a minimalistic office. Depending on where I am, there are either 2 or 4 screens. That is it. There are no special monitors or water-cooled PCs. My secret ingredient is a couple of files on my hard drive. There is my PowerPoint presentation on one screen. There is a Microsoft Word document on another. The PowerPoint file is my cue. At game time, before I begin to trade, it's time to become someone else. In the movie Gladiator, why does Maximus Decimus Meridius rub dirt on his hands before combat? It's a ritual. He must immunize himself before battle, to feel nothing, to become an instrument of death, indestructible, so that he can survive another day. Rubbing dirt on his hands is his ritual of leaving his old self behind. Every day from 5 a.m. until 9 p.m., even late into the night, I am battling myself. Trading is a battle of the self. The PowerPoint file contains old trades, mistakes, triumphs, inspirations, and warnings visually arranged to prepare me for the day ahead. I need to become something else, otherwise, I will not make money. This is why trading looks simple when looked at from the outside, but it's not easy because trading successfully goes counter to virtually every piece of DNA stored in your body. In the 1960s, neuroscientist Paul MacLean proposed the human brain has evolved with 3 areas of function: the reptile brain, the limbic brain, and the neocortex. So, who's really in charge when you are trading? It's your reptile brain, your base self, that's really in charge. When you are startled, and you react, perhaps you detect a wobble in your stomach, a vibration in the lower back. That's your reptile mind preparing you for survival, triggering a fight or flight response. Will you run, or will you fight? Your subconscious reptile mind has only one function, and that is to protect you. It does this whether you want it to or not. And this is a problem, because to be successful as a trader you need to be very good at losing. This means constant conflict with your built-in subconscious protection system. A system that protected you from death as a caveman guarantees you'll not survive as a trader, unless you can learn to overcome it. And overcoming it begins with accepting pain. One exercise I use in the morning is closing my eyes and playing out a scenario. I imagine I lose a large amount of money. I will often use an amount that has some significance to me, such as the cost of my last car, or the cost of my son's college tuition, or the size of a memorable loss. Say for the sake of the argument that I have opted to meditate on losing £78,000, I will see myself losing the amount. I will let it sit there, in my consciousness. I will let it take hold. I will imagine what I will not be able to buy because of the loss. I will make it as emotionally vivid as I can. Now I will turn the table. I will now imagine that I am winning the same amount. I will imagine that I am winning the £78,000. What will happen is that my emotional response system will not allow me to feel a reciprocal sense of joy to the misery I felt earlier. Neurobiology has shown we experience a financial loss 250% more intensely than an equivalent financial gain. After going through this exercise of feeling pain and then not feeling pleasure, I then swap back to feeling the loss again. The purpose of the exercise is to align my feelings of gain and loss. In truth, I don't really want to feel anything. I have found that if I get overly happy about a win, I tend to get overly sad about a loss. I don't want that. I am not a dentist who has a win rate of 99.99%. I am a bloody trader who has to live with being wrong around 50% of the time. It is exhausting to feel joy and pain many times a day. I prefer not to feel anything at all, rather than going through that emotional roller coaster. I win. Move on. I lose. Move on. By adopting this attitude and by warming up my subconscious mind, I am able to flow in and out of winning and losing trades, day in and day out, without it affecting my strategy. Pain is inevitable to some degree in life. Someone lets you down, you feel pain. Someone hurts you emotionally or physically, you feel pain. In life, outside of trading, one way to deal with the pain is to talk to someone. As the saying goes, a problem shared is a problem halved. Why a painful experience feels less potent after we have shared it with a friend I don't know. Maybe the act of verbalizing the disappointment puts the problem into a healthier perspective. Either way, you feel better and the pain subsides. But when I'm trading, while the majority look to run away and rid themselves of pain, I do the opposite. I run towards it. I embrace it. I don't want to share my pain. I want to hold on to it. I need it. Whether you are new to trading and speculation, or you have years of experience, you should give this question some serious thought. If you want to be a success in a field where 90% or more fail, how do you think you should approach this task? Trading looks easy on the outside, but in reality it's much more challenging than people expect, because we are hardwired to do the opposite of what we should be doing. This is why 90 out of every 100 people end up losing. The road to consistency, success, and enlightenment in trading begins in the last place you'd ever think to look. Inside yourself. The key. So, here it is. What follows is the key that will unlock the door to your success, the key to breaking down the barrier between the life you want and the life you are leading now. If you want to succeed in an endeavor where 90% are failing, you have two choices. You can study the large 90% losing group and do the opposite of what they do, or you can replicate what the 10% do. If you are not as successful as you want to be, sooner or later you need to change your behavior. It doesn't matter if you've been trading unsuccessfully for 3 months or 30 years, you are much closer to success than you realize. The 90% fail because they interpret the pain messages received automatically from our reptile brain without any modification. You need to learn to recode your brain's messages when pain comes knocking. Instead of reacting and running away, a small group of consistent traders, the 10%, hold fast and run towards the danger, not away from it. The 10% succeed because they have learned to flip the switch. Flip the switch. This will feel very uncomfortable, but it is a discomfort you must accept and embrace if you want to succeed in the game of financial speculation. It is the reason why trading looks simple but is not easy. The paradox of trading is this: by doing what the 90% cannot do, you will become successful. In other words, I expect to be uncomfortable. I expect my trading to cause me anxiety. I am waiting for it. I can sum it up in a few sentences. 1. I assume I am wrong until proven otherwise. 2. I expect to be uncomfortable. 3. I add when I am right. 4. I never add when I am wrong. Assume you are wrong. Remember, I've watched thousands of traders execute millions of trades, and I noticed when most traders enter into a position they assume they are right. In a business where 90% of people fail, your recoding process begins by flipping that switch. I will assume that I will quickly have to get rid of a losing trade. My confidence in this action is not centered around my ability to select the right setup. That is what the 90% will do. Instead, my confidence is centered around trusting I will get rid of a trade that is not performing. I trust myself to know that if this trade does not work out, there will be another one coming shortly. Do you see how I have flipped the switch on my thinking? I am thinking differently to the 90%. I will assume I am wrong until the market proves me right. Flip the switch. When the 90% of traders execute trades, they experience emotions, which originate from their pain center. Now it's only a question of time before their emotionally driven pain threshold center sends them a false signal, causing them to lose. It is a never-ending roller coaster ride of disappointment, lost money, and pain. When I trade, I assume I am wrong. I enter a trade, and the trade moves in my favor. I am trading my account size or the available profit. I am trading the market because I understand the size of my profit is irrelevant to the market. I know my P&L has no influence on the market. I know that my brain's automatic pain receptor will kick in, causing an inbuilt safety reflex to register pain. I am subject to the same built-in automatic pain receptor as everyone else, but the difference lies in how I handle the pain. Instead of giving into it, instead of being ruled by my emotional responses, I have flipped the switch. I have trained myself to expect the pain. I am aware of the pain. It is there. It is real, but I accept it. I have encountered it in training over and over. It no longer acts as a debilitating force in my life. I have trained the fear about my decision-making. Expect to be uncomfortable. How can you have a good time while you are uncomfortable? Logic will say it is not possible. Well, for starters, I think all humans come alive when we strive. We toil in the garden, we work out, we study for an exam. I think it is perfectly possible to be uncomfortable while enjoying a challenging process. As a trading position grows in profit, instead of giving into the fear it will be taken away from me, I flip the switch, using my mental warm-up, my training exercises and visualization of trend days where the market just goes higher and higher all day. I flip the switch in my mind from negative mental imagery to positive mental imagery. I see myself riding this monster momentum wave. I see myself being at the forefront of every tick higher. The 90% will focus on what they want to avoid. I focus on what I want to achieve. The 90% give in to their fears. I expect my fears to come in abundance, and I have a plan for counteracting them. I see a different image. And when I am losing, well, I already expected to lose anyway, so the market disagreeing with my trade will not be associated with pain or fear. I expected it. I have accepted my loss already. I don't entertain the idea of compounding my mistake by adding to my losing position. I have trained that trade out of my mind. It doesn't even enter my mind anymore. My mind knows I want to be big when I am right, and I want to be small when I am wrong. Emotions kill trading accounts. It isn't the lack of knowledge that's stopping you from winning big. It's the way you handle yourself when you are in a trade. I spent a decade observing traders lose money. They were intelligent people who often had great hit ratios, but they couldn't lose well. After reading this far, if you remember only one thing, remember this: in trading, unlike life, the best loser wins. The ideal mindset. There is an ideal way to think as a trader. There is an ideal mindset, one that is flexible to the extreme. It does not care about winning. It does not care about losing. It is a carefree state of mind, but it still acts in your best interest. The ideal trading mindset has no fear. If you are alarmed by this statement, then pause for a second. The ideal mindset may have no fear, but the ideal mindset is still acting in your best interest. The ideal mindset might be fearless, but it is not reckless. Fear plays a significant role in explaining why people lose the game of trading. This fear can manifest itself in several ways. It can be the fear of not being in the market and missing a good move. It can be the fear of staying in the market for too long and seeing the open profits disappear. Can you acquire an ideal mindset? Yes. Without a doubt. You may have to grow into it. You may have to begin a period of significant introspection and get to know thyself. I will discuss how to get to know yourself as a trader shortly. The ideal trader mindset does exist, and you can train yourself towards this state of thinking and believing. When you arrive at this state, it means you are able to perceive information from the markets without feeling threatened or fearful. Does it mean you will never lose? No. You will have losing trades just like everyone else. However, the ideal trading mindset is as at peace with losing trades as it is with winning trades. Neither will impact your ability to unemotionally and dispassionately perceive market information in a non-threatening frame of mind. Your emotional state will stay in balance. Every trader has experienced periods of being in the zone, of being bombed by the soothing feeling of the ideal mindset. It often happens when certain circumstances are present. For me personally, I experience that sense of calm whenever I am trading while on holiday. One story stands out. I was on holiday for 14 days, and I traded every day from my holiday home. I was totally at peace, trading only when the market really spoke to me. Otherwise, I was at the pool relaxing in the sun. When I returned to the trading floor, my boss came out and said, "Someone is on fire," and clapped. 14 days later, I had given away all my holiday profits. I remember the story so vividly because it happened to be one of the catalysts that led me to seek a deeper understanding of myself as a trader. Hard-coded DNA. The ideal mindset does exist, but few traders have it consistently. When we do not operate from a frame of mind of the ideal mindset, we are afraid of something. This fear is a manifestation of a lack of trust. We do not trust ourselves to do what we have to do without hesitation, without reservation or internal conflict or argument. Our mind is the problem. Our mind's core objective is to keep us alive and avoid pain. We are automatically wired to think in a way that keeps us alive. This thought pattern is hard-coded into our DNA. It might keep us alive, but it makes trading difficult. The very thing that keeps us alive is the very thing that makes trading an incredibly difficult proposition, until you have learned how to counter your hard coding. The issues we face largely fall into two categories. 1. We associate this moment with another moment, whether we are conscious of it or not. 2. We have a mind wired to avoid pain. We have learned to associate in order to benefit from experiences. Association, connecting past moments with the present moment, and pain avoidance do not go hand in hand with trading. Why do I say this? Why do I say that association and pain avoidance are detrimental to profitable trading? I say so because in trading each moment is unique and anything can happen. Trading is the equivalent of a coin flip game. Since the win ratio of many professional traders, including myself, is not far from 50-50, the coin flip analogy is even more appropriate than you might think. If you play a game of heads and tails, you are probably not too concerned about the outcome. Over time, it will play itself out quite predictably. You will win 50%. You will lose 50%. If you developed a system where you lost a unit on your losses, and you made 1.5 units on your wins, you have yourself a good business. Trading is just like that in many respects. You don't judge your system on the merit of one trade. You judge it over many trades. We do so because even a game of heads and tails will show an uneven distribution, even if the outcome over 100 flips is 50-50. As my friend David Paul once said, there is randomness in the outcome of 1, but there is order in the outcome of 100. He was talking about the coin flip scenario. I once flipped a coin 100 times, and I wrote down the result on a piece of paper. I witnessed 15 heads in a row. At one point I stopped and looked at the coin, as if to see whether there were obvious flaws to it. There weren't. If you had 15 losing trades in a row, I imagine your mental state would suffer. If you had 15 winning trades in a row, you may feel invincible. The market will do what the market will do. It doesn't care about you or your position. It doesn't care if you are in the market or on the sidelines. If you have 15 winners in a row, it doesn't care. If you have 15 losers in a row, it doesn't care. You can't make the argument that just because you have lost on a trade you are now closer to winning. By doing so, you are doing exactly what we need to learn not to do. Every moment is unique. Just because you had 15 heads in a row does not mean the odds of a head are less on the 16th throw. They are still 50-50. Why? Because there is complete randomness in the outcome of 1. That is another way of saying that every moment is unique. However, over time the law of averages will come into play, and over 100 throws, you will experience 50 heads and 50 tails. However, while you may understand this academically, and even logically, there is a good chance you will not understand this emotionally, especially if you just had 15 winners or 15 losers in a row. Therein lies the difference between the trained mind and the untrained mind. I will steadily guide you towards the trained mind, so that you do not succumb to fear. Perceiving information. Information on its own has no power over us. It is our belief system and the energy we give to the information that decide its potency. If you receive an email from an unknown person saying, "You are a dead man," the chances are your emotional reaction will be very different than if you received an email saying, "Du er en død mann." The message is the same. One is in English, the other Danish. On its own, the sentence is merely a construct of letters put together. Once it is decoded by the brain, it is assigned an emotional charge. The sentence is meaningless. It is how we interpret the sentence that causes the emotional response. So, imagine a mindset where you can perceive the market information purely from an opportunistic point of view. You are not threatened by the information. You are not thinking, "Oh God, why am I not in this move?" You are not thinking, "Why am I in this move?" You merely observe and decide from a frame of mind that sees opportunities. It does not see threats. The market moves up and down in ticks all day. They form patterns, which we trade on. These ticks up and down are just ticks. If you have a position on, however, these ticks take on a life and meaning of their own. They validate you, or they diminish you. That is not how you want to trade. That is not an ideal mindset. Focus and attract. What we focus on is what we attract. I believe in that, so it is true for me. The fear we experience causes us to focus on the object of our fear so that we end up creating the very experience we're trying to avoid. I want to give you a simple example of the mind seeking information as a result of what your focus is on. You bought yourself a new car. It is a yellow Volkswagen Beetle. As you drive your new car, you begin to notice other Volkswagen Beetles. You never did that before. Your mind has opened a filter, allowing information about beetles into your consciousness. What we focus on is what we attract. The trader who has a position on in the market will focus on the price movements, the ticks, that move in his or her favor because they relieve pain and give pleasure. Movements against the position create pain. You might be thinking I am stating the obvious. You are right. My point was not to state the obvious, but to point out that this state of mind is not open to other possibilities. The more fear we experience, the less information the mind will focus on. It will narrow its focus. It will stop you from perceiving alternative options. I run a live trading channel, where I trade in real time. When I trade publicly, one type of scenario I am most proud of is that in which I accept I have misread the market, and I change my position. For example, I may have pushed the short side on the Dow Jones Index, and the market is moving against me. I accept I am wrong. I close my position. I open a trade in the opposite direction. It requires a tremendous amount of self-belief to do this when you are trading big size. What helps me in situations of this type is to recite a mantra I have created: focus on the process. Focus on what you can control. I have developed a belief system that allows me to encourage this kind of flexibility. This kind of mindset is possible for you too. When I set out, I wanted to create a mindset that allowed me to perceive information without fear. That is the ideal mindset. It takes time to create it, but your rewards are directly correlated to your effort. Don't expect a eureka moment. Expect to get better and better gradually. Beliefs. Our beliefs determine how we react to information. We were born with a clean slate, and our beliefs are taught and adopted. We were taught what to think. We also had experiences that shaped our beliefs. I will get personal for a second. I felt my mother and father abandoned me at a young age. They divorced and I became the object of their fighting. I see now how that shaped my beliefs, which in turn influenced my choices in life and the decisions I made. The moment I was old enough to take charge of my own destiny, I saved up as much money as I could so that I could say goodbye to that toxic environment and leave my home country. How does this relate to trading? Trading gives us unlimited potential to express ourselves. We can open a trading account, and away we go. You are your own boss. There are no rules. There are no limits. Do what you want. You are no longer influenced or guided by your parents. The world is your oyster. You have total freedom to do what you want to do, when you want to do it. We tend not to want to operate under rules. After all, much of our young adulthood is spent rebelling against parents giving us rules. Trading is a rule-free environment. Unfortunately, the result is quite astounding. Traders have free will, and 90% of them will have a belief system that leads them to failure. In order to prosper in trading, we need a combination of being able to operate under trading rules while not feeling we are being held back, because ultimately, we want to experience total freedom. Essentially, what it boils down to is creating a mindset that always acts in your own best interest. It is a mindset that allows you to see opportunities. It knows your weaknesses and what to be mindful of. It allows you to receive information without being threatened by the information. You can operate from a carefree state of mind. I have created a blueprint for a carefree trading mind. I have changed my beliefs about trading. That is the message at the heart of this book, to change how we think, especially how we think about losing. It is to explain my mindset and teach you the mindset. The old way of thinking is still there. It will always be there. It is part of your personality. But the old belief has no charge anymore. It is faded, diffused. Just because you have said goodbye to an old belief does not mean it isn't still in your memory. I will give you a childish example. We used to believe in Santa Claus. We used to believe if we were good, he would come and visit us to leave us presents. Does it bother you that he is not real? Of course not. You have diffused the emotional charge of being deceived. Your life is no worse off. I have the same sentiment about my old trading beliefs. I am not missing out. I am thriving on a new mindset. I used to think I couldn't live without a cigarette after a meal. Now I can't imagine a life where I stick a cigarette in my mouth. I eat every day, and I never have an urge to smoke. Once I could not imagine a life without a smoke. Now I can't believe I was ever hooked on it. It took me a little more than a week to reprogram my mind. The same will happen to you as you apply my blueprint for the ideal trading mindset. My biggest belief I had to overcome in trading was the associations I made when I was confronted with losses. I had to learn how to disassociate losses from feelings of failure or feelings of wanting to extract revenge on the market to create a state of mental equilibrium. Achieving that was a momentous leap for my trading performance. The Book of Truths. I want to move the narrative towards the practical element of creating the right mindset. You can only dance around the fire for so long. Let's get down to brass tacks. Let's get specific. I once saw a sign that said, "The best views come after the hardest climbs." Proverbs have a way of simplifying complex messages, but they are hit and run in their nature. They don't tell you how to do it. How do I climb the mountain? Telling us to just do it might be well-intentioned, but falls disastrously short of a meaningful description of how to climb the damn mountain. In a similar vein, to be told to just run your profits and cut your losses falls disastrously short of providing a meaningful guide to achieving these noble trading goals. When I started trading, I had the right credentials. On paper, I was academically destined to do well. Emotionally, though, I was like everyone else. I was not making money. I should say I wasn't making meaningful money. I lost more on bad days than I made on good days. Granted, I had more good days than bad days, but the bad days would set me back significantly, to the point where I might as well go and get a job. It would have paid better than my trading did. I didn't question what I brought to the game beyond chart preparation. I showed up. I traded. I studied charts. That was it. I thought that was all there was to it. If it didn't go well, then I had to do more of it. However, I never looked inwards. Then something happened. I read the research, described earlier in the book, on the 25,000 traders executing 43 million trades, and I thought to myself, I am just like them. They all believed they would be profitable. Practically none of them were. It prompted me to start thinking about trading holistically. I had been obsessed with techniques. I had a belief that more is better when it came to technical analysis. Yet, I was not seeing the results I wanted. It got me thinking about thinking and about what I believed. More importantly, I began to wonder if what I considered to be my beliefs were actually helping me to become a better trader. So far, they had not. Your beliefs create your world. How you see the world is a result of what you believe in. Some beliefs are easy to identify. I believe we should look after the environment, so I make sure I recycle. That is an example of a belief. That was an easy example. How are your beliefs shaping your trading performance? Are you even aware of what your trading beliefs are? Your trading performance is a function of your belief system, and only by dissecting your trading performance are you able to uncover what your belief system is. There is an easy way to discover your trading beliefs. Although I say it is easy, it is also hard work. A friend of mine wanted to improve his surfing, so he hired a friend to video him for a few hours during a surf session. He watched himself surf and he was able to identify his issues. He needed to strengthen his core muscles and he needed to trust his wave selection rather than being half-committed, as he often was on many waves. In a similar way, I decided I needed to relive my trades to truly figure out what my problem was. So, I downloaded my trading results into an Excel spreadsheet and went to work. I meticulously went through the trades. I split my trades up into many different categories, with many of them appearing in more than one category. There were trades I held for days. There were trades I held for seconds. There were trades I executed in the mornings. There were trades I executed in the afternoons and evenings. I recommend you read my assessment of my own trading, and you repeat it on your own trading. It is a vital step in understanding who you are and how you interact with the markets. Once you have done that, you will create what I call the Book of Truths. Above all, be honest with yourself, as I was. If you are not honest with yourself, you will not be rewarded with consistency in trading. The courage to be honest with yourself is its own reward. Here goes. 1. I had periods where my win rate exceeded 85%. 2. My average profitable trade was less than my average losing trade. 3. I was a winning trader, but my big losses were seriously denting my overall P&L. 4. I traded well in the first half of the day. 5. I traded well in the first 3 to 4 days of the week. 6. I often gave away much of my profit from the morning session when I traded in the afternoon. 7. I often gave away much of my weekly profit on Fridays. 8. I would do very well on range-bound days. 9. I would almost always miss trend days, and I would often fight them. 10. My biggest losses came from fighting trending moves. The breakdown of my performance was incredibly cathartic. I took great pleasure in reviewing my own mistakes, because it felt like I was actually meaningfully moving towards a better version of myself. I took a very time-consuming decision to put all of my trades on the relevant charts. I created a PowerPoint containing every trade to give me visual imagery of my performance. This is the Book of Truths. I will argue that this process stood out as the single most beneficial practical exercise in enhancing my performance. I was, and I am, confronted daily with all my flaws, and I have a visual representation of those flaws. It seems as if the act of portraying a loss in a visual representation is a much more powerful tool for change than merely writing, "Don't trade without a stop loss," on a post-it note and taping it to your screen. I use the PowerPoint file to warm up every morning before trading begins. I am reminded of the things I am good at and the things that tend to be my downfall. It has become an integral part of my process to ensure I am acting in my own best self-interest. When I started the process of visually recalling my old trades, my old hurts, my old successes, I felt an empowering surge to replicate what I was good at and avoid what I was bad at. I immediately began to trade differently. I immediately saw measurable improvements in my trading. The results were immediate, even if I had to get used to the new way of thinking. I made more money. I became much more trusting of the markets. I trusted that I would be given an opportunity to make money every day. As odd as it sounds, I began to trade less, and I started to make more money. Sure, I wasn't perfect from day one. I am not perfect today either. In fact, one of my beliefs is, don't insist on perfection in trading. One truth I came face to face with was less is more. There was a clear relationship between the time of the day and my profitability. I was nowhere near as profitable in the afternoons as I was in the mornings. Would I make more money if I just traded mornings? The statistics said yes. My heart said no. I wanted to trade, and I felt, or rather my belief dictated, I had to trade in the afternoons. How else could I call myself a trader if I only traded part-time? It was a process of trial and error. This was the immediate benefit from the Book of Truths, but I didn't stop there. I began to seriously question my motivation for trading. I argue that in a business like trading, where 90% fail to make a positive return on their trading account, the only way to separate yourself from the masses is to acknowledge that your mind is either your best friend or your worst enemy. If you don't prepare your mind ahead of the game, and you experience adversity during the game, your mind will most likely work against your prime objective. Your prime objective is not to make money. Your prime objective is to follow the strategy you have developed. More importantly, your prime objective is to follow the process you have designed for yourself. If you follow the process, the outcome will take care of itself. I don't set goals. I just focus on my process. I am a process-oriented trader. I don't think being overtly goal-oriented will help you achieve your goals. Of course, the goal is to win. But a mind subjected to adversity is a mind in stress. A stressed mind needs structure and process. Otherwise, it will succumb to feelings of fear, revenge, and desperation, and the decisions it makes will originate from these feelings. Who wants to make decisions about the well-being of their financial health based on fear or stress? The mind needs guidance. I read about an American football coach who, during the halftime break, gave specialized talks designed to reawaken the imagination of the players on his team. One time his team had taken a beating in the first half of the game. During the break in the locker room, the coach put on a special video he had prepared. It showed some of the greatest comebacks in football history. The purpose of the video was to give the players a path out of their stressed state. It gave them mental imagery of what was possible. Coupled with the right kind of motivation, encouraging the players to focus on the process, staying present in the moment, waiting for the right opportunity and trusting the process, their minds had gone from being stressed to being prepared. I want to remind you that the first part of my trading life was spent on a trading floor, observing traders, thousands of them, go about their daily lives. I am adamant in my claim that those who were behind at halftime had no mental tools to help themselves, and as a result tended to dig the hole they were in deeper and deeper, as the day wore on. Leaving the old self. Remember how Maximus ritualistically rubs dirt on his hands before combat in the movie Gladiator? How, through this symbol of mental preparation, he was leaving his old self behind. Well, I too have to leave my old self behind. I too have to become someone else for the day. Charlie DeFrancesca, the legendary bond trader in the pits in Chicago, said that good trading goes against normal human instinct. To succeed, you have to get used to being uncomfortable. Trading is a battle of the self. Every morning I have to shed my skin and become someone else. The Book of Truths is key to my transformation. It arouses a desire to do better than the old pattern of behavior. I am certain that had I not taken the steps to focus on my mental game and confront myself daily with my old behavior, I would not be where I am today. I argue this to be the case based on my observations of diaries. One of the catalysts for my trading transformation came from tidying up my old office cabinets. I found old trading diaries in which I had meticulously described my trading day. As I read through the diaries, which spanned a decade, I saw how desperate I was to make trading work for me. I saw how day after day I promised myself not to add to losing trades, how I promised myself not to trade well from Monday to Thursday and then lose it all on Friday, how I promised myself I would stick to one setup, and so on. As I read page after page of trials and tribulations, but mostly trials, I realized that the Tom whose words I was reading was in real pain, but he was not transforming. He was repeating the same mistakes day after day. He might have been increasingly technically competent, as his studies took him deeper and deeper into expert territory of technical analysis, but he kept making the same mistakes when his mind became stressed. As I have said before, it was not an epiphany. My change came slowly. It was a gradual realization that all my chart studies didn't move me meaningfully towards the goals I wanted to accomplish. Rather, they merely distracted me from the real problem, which was my behavior when things did not go to plan. Instead of focusing on the process and having tools to get me to operate from a stress-free mind, I succumbed to foolish trading, intending to make back the lost ground. My mind desperately wanted to get rid of the pain of having lost money, and its solution was to chase every movement in the market recklessly. And all I did was dig the hole deeper and deeper. The Book of Truths will give you up close, face-to-face time with your own shortcomings. It made me realize what my faults were. I also started plotting my good trades. I felt it was necessary not just to remind myself of the behavior I wanted to avoid. I should also remind myself of the behavior I wanted to strive towards. The charts I use to prepare for each trading day, to warm up, are my old trades plotted on a chart. That way I can emotionally relive the trades and reinforce the behavior that is good for me and remind myself what my weak points are. An example. Friday the 4th of March 2022 was an extremely volatile trading day. A colleague pointed out to me that Brent oil was soaring. I looked at the chart, shown in figure 25, and I thought, wow, it really is. I bought the first retracement on this 10-minute chart. Now there is nothing wrong with this entry. I am trading with trend, but as I look back at the trade, I acknowledge that at that precise moment in time I was not trading from an emotionally stable point of view. I was eager to get on board a move, based purely on the opinion of another trader. So, I just bought it without much thought to it. And I had no stop loss in mind. I just put an arbitrary stop loss, for safety. See figure 26. This is the power of the Book of Truths. I want to remind myself of things like that. I want to remind myself, in the morning, before the trading starts, that Tom Hugard trades best when he is calm and is not caught up in an emotional whirlpool of excitement and a brain awash with adrenaline and dopamine. I looked at my trading monitor and saw my position losing me money. I reminded myself that, although I got caught up in the emotions of another trader, one that I respect, I am not him. I am me. I closed the trade, and then I waited. I had made an impulsive trade, an emotional trade without a real plan or a real setup. I wasn't annoyed so much with the losing trade as much as I was annoyed with suddenly being impulsive and acting without truly thinking. I could have spent 30 seconds thinking it through and the outcome would have been very different. I calmed myself down, and I thoroughly analyzed the chart, and I decided upon a better entry point. I used my process, the tools that work for me. And then this pattern in figure 27 showed up. It was late in the day, and I was prepared for a restful evening after a long trading week. I bought Brent, and I held it. The setup is simply a harmonic retracement. The first retracement and the second retracement are identical. It gives razor-sharp entries, where it is easy to control your risk. I want to remind myself of the things I do well. I want to remind myself of the things I can be prone to when I am not calm. I want to do that ahead of the open. I accept that I will never be perfect. I will at times still make stupid Brent oil trades on a Friday afternoon because a friend of mine is telling me of his success, but I like to think that like a missile I will self-coordinate as new data becomes apparent, and I like to think that my mental preparation makes my mistakes short-lived. Trust. My review of my trades revealed that I didn't trust myself or the markets. Profitable trading requires trust. If you don't believe it can happen, you should not even start. If you don't trust, then you will not make money. Therefore, before you start trading again, you have to work on your beliefs about yourself and the markets. As I see it, trust falls into two categories. Trust yourself. You have to trust that you already have all the tools you need to make a living from trading. Yes, you need to acquire a certain competence level in the field of technical analysis, or whatever edge you use to make trading decisions. I continue to study technical analysis, and I do so to improve my understanding of the ever-changing nature of the markets I trade, but it is not technical analysis that will make me money. It is trusting that I already have all the skills I need to make money consistently. The reason why I was not more successful in my early trading was not because I didn't know enough about technical analysis. It was because I thought the only thing I needed was technical analysis. However, that was, and is, simply not true. I had not focused my time and attention on matters outside of technical analysis. My focus was not on the right things. My technical savvy was not matched by an emotional maturity, because I had not spent time working on that side of my game. You need to trust that you already have all that you need. Otherwise, you will not bridge the gap between what you know you can achieve and what you are achieving. You need to believe. The belief comes from doing. I will address that in a moment. Trust markets. The second trust consideration is the trust in the markets. When I go to work in the morning, it would be great if the perfect setup manifested itself before my eyes right at the opening bell. However, it rarely does. I use a 5-minute and a 10-minute chart as my primary trading time frame. A typical trading session runs over 10 hours for me. That means I will be confronted with a total of 120 candles, bars of 5-minute duration. As a result of my review of my trading performance, I came to a realization. I didn't trust the market would give me the opportunities I needed to make money. It was a debilitating belief. I set out to prove that I was wrong in that belief by reviewing 10 years' worth of intraday data from the handful of products that I traded most frequently. Now I wasn't just studying for the sake of identifying patterns. I studied to prove that the technical analysis setups that served me well would repeat every day. I arrived at a new set of beliefs. I came to believe I can trust the market to give me an opportunity to make money every day. I came to trust the fact that at least 2 or 3 of those 5-minute candles would produce a great trade entry. I came to trust that the market would give me a perfect entry point, such as a double top in a higher time frame downtrend or a continuation signal. In conclusion, I shaped a new belief around the evidence that I laid bare through my research. I came to accept that I can produce a good living from trading, from waiting for those ideal setups. But those ideal setups don't necessarily materialize when I want them to, in the time frame I have at my disposal to trade. I need something else beyond trust. Trust is a vital part of the journey to making the markets your playground, but it is not the only component. I needed to work on another part of my behavior. I would often tire before the afternoon trading session. I would often tire as the week progressed. This led to poor decisions, which can be directly attributed to boredom and impatience. Patience. I realized that my patience was my weakness. However, there is more than one kind of patience. For example, a mother teaching her young child to read may experience a sense of impatience, but the mother will remind herself that eventually all children learn how to read. The impatience that a parent may experience is mitigated by the perceived time horizon to reach the end goal. We know our children will learn basic reading skills as long as we persist. We simply have to maintain our patience as our little ones inch their way towards the desired skill. You can't argue that patience is a quality directly transferable from parenting to trading. As a parent, you can tell yourself you will patiently work towards your child being able to read. However, you can't say that you will patiently wait for the market to hit your desired entry point, because it might not hit your desired entry point. As a result, you will experience emotions that a parent doesn't. You will experience a fear that the market will move without you. You will be fearful that the market will not give you an opportunity to jump on board. Without the right kind of conditioning, you will act upon these fear impulses. Had I not gone through all the data I had, I would not have been so assured in my decision to wait for the right setup. I accept my process is thorough, but with that preparation comes significant financial reward. Without a doubt, one of the greatest flaws I saw traders exhibit during my decade on a London trading floor was the idea that it is too late to join the trend. It was a common occurrence during trend days to witness clients continuously try to find the low of the day. On those days, our clients lost the most. If the market was rallying, they would either do nothing or they would try to find a place to sell short. If the market was falling, they would do nothing, but more likely they would try to find the low of the day and buy. Considering the action was so common across such a large group of individuals, I conclude that there is an inherent trading flaw in our thinking which makes us want to go against the trend. I have previously mentioned this supermarket mentality, which compels us to seek value. Another reason this behavior is commonplace is because of the prolific use of chart indicators that display what is technically known as overbought and oversold price levels. The use of overbought and oversold indicators has a terrible track record in trending markets. To my mind, patience is a skill set that can make the difference between being an abject failure or a wizard. I use the word skill set because I believe that patience can be developed. I developed my patience in trading using two methods. Both are practical in nature, but they are very different in their application. One is a proactive exercise. One is a reflective exercise. Expanding my field of information. The proactive exercise evolved around the concept of expanding the field of information. I print out the charts of my favorite markets every night, while the trading session is still fresh in my mind. For example, I will print out the DAX index chart and the FTSE index chart on both a 5-minute chart and a 10-minute chart. The reason I am printing out two time frames is because of perspective. I found that my use of the 5-minute chart prompted overtrading. By considering the 10-minute chart, I am forcing myself to slow down my decision-making. This act of slowing down my time perspective also strengthens my patience. I see things on a 10-minute chart that give me a greater clarity than if I had seen them on a 5-minute chart alone. Patience, however, is not a quality that is easy to come by. I am a man in my 50s. Over my lifespan, the world has pandered to the impatient. When I was a child, if my family ran out of milk on a Sunday afternoon, I would have to wait until Monday morning before I could purchase another bottle. Everything was shut on a Sunday. Forgive me if I sound like a relic. I am really not. I love technological advances. So many wonderful things flow from our advancement of living, but the flip side of the coin is that we as a species have also become impatient. That is important to remember when you set out on a trading journey. Not long ago, I read about a gentleman called Navinder Sarao, a trader who became synonymous with the infamous 2010 flash crash. In the book Flash Crash, by Liam Vaughan, it becomes apparent that some of the primary skills that Navinder possessed were focus and patience. According to the book, Navinder Sarao would hide himself away from the other traders he worked with, so as not to be disturbed. He needed quiet around him to exercise focus and patience. The exercise of printing out the specific charts every day instills in me faith that every day the market will give me an opportunity to make good trades. The exercise is also an opportunity for me to discover new behavior in the market and continuously train my mind and eyes to spot patterns. I happen to believe that you only see things you have trained your eyes to see. Imagery and breathing. The second exercise is hard to begin with. Some call this exercise meditation. Some call it visual imagery. I don't have a name for it, but I know what I want to achieve. I want to calm down my mind. Depending on the mood I am in, I will use one of the following tools to keep my mind trained for the task of being a high-stake day trader. I sit quietly in a comfortable position, and I observe my breath. I breathe in for 7 seconds, and I breathe out for 11. I repeat. I will do as much or as little as I need to feel calm coming over me. Sometimes it takes 5 minutes. Sometimes it takes 15 minutes. The purpose of the exercise is simply to calm my mind. Through the use of breathing exercises, I have been able to increase my attention span significantly. I was hesitant at first. I was even hesitant to write about it. It has that taste of a new age fad. The reality is that calming your mind through breath work is used extensively by high-performance athletes. I read extensively on the topic of meditation amongst Formula One drivers. It was both a surprise and a relief that ultra-competitive sportsmen and women, people I admire and am inspired by, are turning their sight inwards to improve their edge. I have to be upfront with you. I have no formal training in meditation or imagery. I simply trust and let myself be guided by what enters my head. My mental imagery is designed to place myself in physically dangerous situations. I may be face to face with an alligator. I may climb a steep rock face. I may surf a monstrous swell. The exercise is simple. I want to elevate my pulse through imagery. Then I want to consciously focus on my breath and simply accept the situation for what it is. The aim is to confront the imagery and remain calm. Once I am calm, I see myself trading the absolute biggest stake size I am allowed by my broker. I see the market move against me, and I visualize my P&L go deeply into negative. I feel my pulse elevate, and I focus on calming it down. I repeat this process over and over. I see myself riding a trend higher and higher. I see my P&L grow larger and larger. I am waiting for my mind to tell me to take profit. Then I stop the tape and flip the switch. I calm my mind down, and I see myself looking at my P&L dispassionately. I calm my breath until I am able to simply observe my profit grow larger and larger as I trend with the market, higher and higher. The goal is simply to be an unemotional observer of the market. The goal is to act without fear, without hope, without anything but an objective assessment of the price action. Ask for help. I believe that beliefs shape our lives. I believe not all my beliefs are beneficial to the life I want to live. I accept they are there, and as my self-knowledge evolves, I address them to the best of my ability. I have come up with this back-to-front idea of how to address my beliefs. It evolves around the old saying, I will believe it when I see it. How about turning it on its head to say, I will see it when I believe it? This argues that you must believe before you can see. Many of our beliefs have been part of our construct since our formative years. They are not going to go away without a fight. Of course, you might decide not to fight them, but to accept them. I call this process ask for help. I sit with a blank piece of paper, and I pose a question. It could be, why am I afraid to join a downtrend after it already started? I write down everything that appears in my mind. I sit with my eyes closed and I observe my thoughts. I do not censor myself. I just sit and ask and listen and write down. I may write for 10 to 20 minutes. What often appears on paper are thoughts straight out of the psych ward. It scares me at times how brutally to the point and honest the answers can be. It can be quite horrifying to read the things the subconscious mind brings up. I don't judge. I accept. When I am working with my beliefs, fighting those beliefs will not work. I think giving negative energy to a belief will only cause it to fight for its life. The only thing that works is complete acceptance. I accept what is there. I understand it. It allows me to retire it. I diffuse it. If I approach it from a perspective of, I hate this belief, it will enforce and entrench itself. Say I have a belief about trading that suggests I need to make my money quickly. I need to get in on the move first thing in the morning. If I want to diffuse this belief, because I have strong evidence to suggest it is destructive to my trading account, I will ask for help. I will accept the belief. I will diffuse its negative energy, and I will replace it with positive energy. I will reinforce a new belief such as, I will wait for the first 10-minute bar to complete before I make a decision to trade. Unfortunately, beliefs do not have the power to dismantle themselves. All beliefs demand expression. Desire and willingness to ask questions from a sincere space, with a sincere mindset, will give you answers. When I use the ask for help process, I know it is complete when I can distill my question into a short one-sentence answer. Then I know I have condensed the exercise into its lowest common denominator, and I have diffused whatever belief I had that didn't serve me. The old memory will always be there, but the context has changed from negative to positive. It is important for me to remind you that money is a byproduct of the ideal trading mindset. You are creating a process that will guarantee an optimal mindset for your trading life. The essence of good trading lies squarely in how we think and perceive information about the markets. It has everything to do with how we think and how we live our lives. Today I spoke to a friend of mine. We had not spoken in a while. I consider him a very close friend, and it was a joy to reconnect. Ash spoke. I listened intently. You have 2 ears and 1 mouth. Use them in that proportion. He was talking animatedly about his trading and how well it was going. In between the stream of sentences, I picked up on a sentence that spoke volumes. I am still working on increasing my trading size. I thought long and hard about that sentence, knowing I was going to write this final chapter today. My friend first spoke to me about increasing his trading size back in 2015. Today it is 2022. He has spent 7 years talking about increasing his trading size. What does that tell you about his desire to increase his trading size? Do you think there might be a misalignment between what he says he wants and what he is actually doing to get what he wants? I often tell my children this. Do what you have to do, so that you can do what you want to do. I tell them to make up their minds what they want, but think very long and hard about it first. If you say you want something, and then you do nothing about it, then you can be damn certain there is a misalignment between your conscious and your subconscious. When I am faced with a situation like that, I use the ask for help exercise, and I always get a brutally honest answer. The most common answer I get is, actually you say want it, but you don't. The idea of deciding what you want can undo a lifetime of negative energy surrounding your beliefs and your belief system. The power of making up your mind will remove all negative energy surrounding a belief system. I have come to accept that many people do not want to do that. We fall in love with our drama. We cling on to our drama because it validates us and gives us attention. When I am out of sorts, angry, frustrated, I ask questions and work my way backwards. I work my way to the source of the problem. Anger is often a self-defense mechanism. If I am angry, I need to know what the underlying belief for the anger is. So, I ask. I am often told I am very disciplined. This is not true. The word itself is an oxymoron. Discipline implies the use of force and will. My action flows from a love of what I do. I don't have to apply will to do what I do. Those who are self-disciplined don't think of themselves as self-disciplined. They are just expressing themselves in harmony with their own dreams and goals and desires. When you watch spiritual movies like The Secret and listen to self-help tapes, you get this sense that the universe is a menu, and you can help yourself to whatever you want. I find that to be one of the most distressing aspects of the self-help industry, be it neuro-linguistic programming or law of attraction or whatever name the latest fad goes by. I have stood in an auditorium and listened to motivational speakers make their audience shout out whatever grievances are holding them back, and then push the audience towards their private island retreat for untold sums. I never believed in it. I don't believe anyone ever achieved anything spectacular without putting in a massive amount of effort. I know I put in the effort. I know that everything I do on a daily basis is the result of grit and determination. I am not talented. I am hard-working. I am not gifted. I am determined. I am not lucky. I am persistent. 20 trades. My friend Dr. David Paul gave me an exercise, which at its heart is designed to strengthen the process of your trading. It is as simple as it is difficult. Your job is to execute 20 trades as the signals appear. One by one, you take every trade signal as it comes. The purpose of the exercise is not actually to make money. You will probably break even, and that is fine. The purpose of the exercise is to smoke out your internal conflicts and your unresolved emotions. It has at its core the idea that if you can execute 20 trades without any kind of conflict, you are trading from a carefree and fearless frame of mind. This means you are trading from the perspective that 1. Anything can happen, and you are emotionally detached from the outcome. 2. Every moment is unique, and you are no longer drawing associations between this moment and another moment. You are pain-free. 3. There is a random distribution of wins and losses. You accept the outcome as if it were a coin flip exercise. 4. You don't have to know what will happen next to make money, so you trust the process, and you focus on controlling the only variable you truly can control, which is how much you want to risk on this trade. The purpose of the exercise is to add energy to your beliefs. Until you can do that without conflict and unresolved thoughts and conflicting energy issues, the negative charge will not dissipate. How do you know when you are successful? When you can trade without any conflicting or competing thoughts. The results are not important during the exercise. This is a process exercise. You may have to repeat the 20 trades over and over until you come to a point where you find that you are firing off trades without fear, without hesitation, without connecting this moment with a past moment, and you accept the outcome dispassionately. When you arrive there, you really have arrived. Disassociation. A friend called. She had put up a post on a social media outlet, and her post was very ill received. She endured a torrent of abuse for what was a well-intentioned post. She called me for help. I read her post and the slew of abusive comments. To me, however, they were just words. They were words without energy. I dispassionately read the posts, and then I explained to her what to do. As traders, we need to work towards being as dispassionate about our trading as I was about her social media post. The more we work on this, the better we will trade. Some will argue against me. Remember, I am writing this from the perspective of what works for me. How do you do trade dispassionately? How do you disassociate yourself from feeling anything when you are trading? Well, that is what my exercises take care of. If you want to be able to receive information from the market without feeling threatened, it will not happen by itself. I believe working on what you think and how you respond and evaluate your responses will improve your trading in measures you would struggle to appreciate right now. I once sped down the Autobahn doing 186 miles an hour. Yes, it was reckless. Whilst doing it, I wasn't wondering if there was milk in the fridge or if I had remembered to floss my teeth this morning. I was in the moment. Focused. That is what I want to bring to my trading every day. Every moment is unique. That does not mean we have to act like a formless blob with no memory of the past. There will always be some degree of correspondence. However, just because I was rejected by a girl the first time I invited her for a dance does not mean I will be rejected the next time. But my mind might think so I may have an argument with my conscious thinking and my subconscious beliefs. My rational mind might say, the next girl will say yes to a dance. My subconscious mind, unbeknownst to me, might say, no way amigo, give up, she will never dance with you. If you have a moment of doubt before venturing over to ask the lucky lady, you know you are not aligned. When I experience this in my trading, I will ask for help, or I will use imagery to resolve whatever is going on in my head. Mind loop. My training involves accepting pain and making it part of my existence through habit and repetition, so that my degree of pain tolerance is expanded. I also have to train my mind about expectations and how to deal with unrealized expectations. This requires a tenacious effort, through journaling, mental imagery, and asking for help. You may quite rightly ask, does it work? I think it does. It has revolutionized my trading. As I type these words, in March 2022, I have not had a losing day since September 2021. That is nearly 7 months without a single losing day. I don't think this should be celebrated. I am not writing this to show off in any shape or form. The intention is to inspire you to take the mental side of trading almost as seriously as the technical side. If I were to describe the beliefs that are the foundation for my trading, they would resemble a flowchart, one where the entire mindset ecosystem forms a loop. My trust, in the markets and in myself, supports my patience. My patience, that a setup will materialize, feeds my confidence. My confidence, that I will win, dictates my inner dialogue. My inner dialogue, what I tell myself while I am trading, supports my process-oriented mindset. The process enables me to stay focused in this moment. I support this loop with my mental exercises. They feed, nourish, and sustain the loop. I am a process-oriented trader. I do not believe in goal setting. There are no post-it notes on my monitor reminding me how much I want to make today or this month or year. I have no monetary goals or pip point goals. I will take what the market will give me. I never trade with targets. By being utterly focused on the process as opposed to being outcome-oriented, I ensure that I am staying present. When you are present, you don't connect past moments with this moment or future moments. You are right here, right now. Being present is what some would call mindfulness. I call it focus. I call it concentration. I call it knowing what I want. I want to win. That is my overriding motive for trading, to win. I want to win, but I don't mind losing. However, I know that if I forget all about winning, and I focus on the process, I will win. It is an idiosyncratic conundrum that for a long time I just could not believe and give into. How can I win if I am not focused on the goal at all times? It took me almost a decade to figure out that process is everything. Don't focus on the goal. Sure, know what the goal is, but focus on the process. Trust the process. I built my trading life around this mind loop. How does the loop look? I trust. The research underpins the trust. The trust supports the patience. The patience is underpinned by the mental exercises, and it nourishes my confidence. My internal dialogue is driven by a process-oriented mindset, fueled by my confidence. I focus on what I can control, my mindset, my risk approach, and I let the market do what it wants to do. Whatever it does not fuel the fearful side of my mind. That has been trained away. I am not afraid of the market. The only thing I am afraid of is that I do something stupid in the market. As I trust myself, this does not happen. I trust that I have the skills to make money, and I trust that the market will give me opportunities to make money. This trust has been nurtured and strengthened by my intense study of market charts for the time period I desire to trade. The trust is further strengthened by continuous dedication to my vocational skill set. My patience flows from my trust in the market and in myself. I have built an emotional connection between trust and patience. I trust the setups will come if I am patient. If I am patient, I will win. Winning means more than anything else to me. If I am not patient, I will not win. I will do anything to win. Therefore, the trust overrides any emotional impatience that may arise in my mind, because I trust that if I miss this signal, there will be another one coming. My confidence comes from continuously working on my game. I don't learn technical analysis once. I learn all the time. Some markets move. Some markets are dead. Some markets require larger stops. Some require you to trade with orders because they move so fast. The markets are forever changing, and I change with them. My inner dialogue stems from the trust and the patience and the confidence. Of course, yours truly has bad trading days. I just don't let it bother me. I am grounded in this moment. I focus on the process. That is all I can do. I can't dictate to the market what it must do. I must be like water and flow. I must flow with the market. I don't fight the market. I flow with the market. Just flow, I tell myself. This is what lies behind the process. I never expect to be comfortable when I am trading. If I am comfortable, I know I am not pushing the boundaries of what I am capable of. I know that to get the best out of myself, I need to be a little uncomfortable. I will give you an example. I sold short the Dow index in my Telegram channel, time-stamped for authenticity and verification. I have marked my entry point in figure 28. Initially, the market moves against me. Then it turns and trends lower. As it trends lower, I am mindful of my mind saying, "Take profit." That voice used to be much louder. Now I am so focused on the process that the voice is no longer heard. I focus on the process, not on the outcome. However, at one point I have 200 points in profit and the market sits at an old low. I have to accept that there is a real possibility the market will rebound from there, and much of my 200-point profit will disappear. That is being uncomfortable. I accept it and decide to let the position ride. Do you know why I let it ride? Because I know myself well enough to accept that if I took profit and the market then continued lower, I would feel awful. The pain of seeing a market giving you even more profit when you are not on board is much greater than the pain of seeing some of your paper profit disappear, to me at least. This time it worked. Tomorrow it might not work. I have to trust the process will sustain me over the long run and be less concerned about the outcome of a single event. Remember, there is complete randomness in the outcome of one event, but over hundreds of observations there is no randomness. A trading life is not defined by what we do every now and then, but by what we do over and over. You will never be able to trade without having losing trades. The whole purpose for giving this book the title it has, Best Loser Wins, is to illustrate this point right from the beginning. The one who is best able to lose will win the game of trading. The survey of 25,000 traders executing 43 million FX trades over a 15-month period illustrates this point perfectly. Overall, they had more winning trades than losing trades. Out of those 43 million trades, up to 61% of them were winners, depending on what currency pair they traded. What does that tell you? It tells you that those 25,000 traders have a good grasp on the markets and where to place their trades. It tells you that if they were somehow able to operate with a 1-to-1 risk-to-reward ratio, they would win 61 out of 100 and lose 39 out of 100. That is a winning formula. That creates a net positive trade flow of 22. That is a business model that has an integral foundation. The problem is that the survey shows that when they win on average 43 pips. When they lose on average 83 pips. In other words, they lose twice as much, almost, on their losing trade than they make on their winning trades. Let's say 100 trades are executed. 61 winners at 43 pips equals 2,623 pips. 39 losers at 83 pips equals 3,237 pips. What does that tell you? It tells you that they are good at picking winners, but when they are faced with a losing trade, they don't have the mental discipline to cut the loss. What does that tell you? It tells you that they need to work on their mental game so that they are better equipped to handle losses. Their minds are most likely wired to associate pain with taking a loss. The mind has at its core a mandate to protect you against pain, physical as well as mental pain, perceived pain and real pain. Final words. Your path to becoming a profitable trader lies not in better understanding the markets, but in better understanding your mind. Your mind and how you operate it will dictate the level of success you have as a trader. I am going to go out on a limb and tell you something about you. People reading this book could have fallen into one of two categories, but I doubt it. I doubt that new traders, who have never traded before, will ever gravitate towards a book like mine. They are more likely to buy books that have titles like Mastering Trading or Trade Your Way to Financial Independence. This kind of book will be 300 pages of technical analysis and most likely not contain a single mention of losing trades. It will contain page after page of perfect chart examples. This book, I speculate, will be read by the people who previously bought the sort of book mentioned above, but have come to the realization that the gap between where they are now and where they know they can be can only be bridged by a better mindset. The advantage I have in writing this book is that I don't have to establish my credentials. I have a 4-year public track record, time-stamped and readily available for anyone to read. I post my broker trades in Excel format on my website and in my Telegram channel daily. There are plenty of bad trades in that track record, I assure you, but somehow I still manage to make money overall, and quite significantly so. Therefore, the focus now needs to be on the actual steps I have taken, and still take to ensure I stay at the top of my game. That is where you are headed now. I want to finish the book on a note which is important to me. I have described a process that works for me. It is based around my particular beliefs. Those beliefs are the result of my particular life circumstances. I believe that beliefs are defined by one's own desires and needs. As a result of my desire to be a profitable trader, and my need to create financial stability in my life, I have acquired beliefs that are consistent with this goal. That said, I accept that my way is not the only way. I don't describe the way. I describe my way. Whatever you decide is right for you is right for you. Trust it. I periodically suffer from verbal diarrhea on the mental aspect of trading. I post my musings on both www.bestloserwins.com as well as on my website www.tradertom.com. Have a wonderful journey. With love, Tom Hugard.